All right. So everyone in the class, please confirm. Can you all see me, hear me? Are we all live? Yes. So all the live people sitting here, very good evening. Welcome to this session. Who all do we have in this live class today? Come on, tell me. Yes. So live people, are you all there? So welcome everyone to this video where in this marathon in full English language we are going to do some particular concepts and solve category A, which means LDR questions from those concepts. So let me very clearly tell you what this video is about. We identified some 27 topics which are of high priority by the institute because they have been repeatedly asked, right? Of those 27 topics, we tried to cover those 27 topics in terms of concepts and as well as their questions of category A. This is part second of this video where first part has already been recorded. In the first part, we have done derivatives, forex, derivative, forex, equity, business valuation, and portfolio management, right? In the second part, which is this one, we are going to do mutual fund, mergers, acquisition, IRM, IRRM, IFM, advanced capital budgeting, risk management, security analysis, fixed income securities, and so on, right? I will just very quickly give you a brief of that another video, right? So let me just give you a small brief. These were the videos that we had done in part 1. The link of the part 1 is there in the description. These are other chapters that we are going to do in the video today, right? Someone is asking, what about Hinglish? For Hinglish, we are already done with marathons. Go to my YouTube channel, go to the live section. In the live section, you will be able to find the Hinglish marathons. This video is particularly about English. Yes. So you all need to tell me, are you people all ready? Who all do I have in this live YouTube marathon today? Come on. So I can see Tushar is here. Very good evening. Then come on, others in the class. Give me your names in the chat box. Who all do we have in this live class? Please tell me. So Mugant, is that your first name? He's saying thank you for the English marathon. Yes, Arjun is here. Esther. I think you were there in part 1 as well, right? ANN. Is that your first name? How do I pronounce your name? Yes. So great guys. Let me tell you. This video does not teach you do the topics selectively, but rather we identified some very important topics which are repetitively asked, right? Which has coverage of on an average 67 marks in the past 17 exam papers of the institute, right? Sir, these are the topics which have been repeatedly asked by the institute. These topics, when are broken down into chapters, right, this is how it look like, right? In this video we are going to start with the chapter of mutual fund because the first 4 chapters have been done. If I talk everyone, so if you want to go through that analysis video, you'll be able to find it in the description of this particular video, right? That analysis video one can look at and figure out how important those topics are, right? So Raja is here, Christy is here. Esther is saying, sir, part 1 is very effective. So let's make the part 2 be very effective. So all the live people watching here, we started it at 7. It will go by around 1 p.m. at night. Yes. So are you people going to be there till the end, covering all these topics with effective learning, with learning the application of those concepts to the practical questions? Come on. Who all do I have in the class right now? Who can commit that, sir? We are going to be there right till the end. Come on. Who all are going to be there? Tushar Deep is going to be there. N is going to be there. Bhuvi is going to be there. Arjun is there. Miral is going to be there. Come on, everyone else in the class. Are you all going to be there? So we are done with both the parts of marathon in English language. We are doing it specifically for you people so that you have also access to everything which they have access to, right? So great. Super happy to see your excitement. Let's keep that commitment. Let's keep that determination. Let's keep that discipline till the end and be there in the video. So let's get started, sir. We'll start with the chapter of mutual fund, right? In the mutual fund, I have observed that institute has repeatedly been asking the question, First question that it asks is with respect to the NAV calculation. It will give you the details of asset liability, ask you to calculate the NAV. Second, it asks you to calculate the return, right? What exactly in the return it asks, I will take you those practical questions, and then it asks you about the reinvestment plan, the question relating to reinvestment plan, right? If we are able to understand these three concepts and solve the practical question, then we will be done with significant repetitive question. For example, reinvestment plan has been asked 8 times, NAV calculation have been asked 5 times, and return calculation have been asked 4 times out of past 17 attempts in the exam. Cool. So we'll start with the NAV calculation, then return, and then the reinvestment plan. So all those people who are watching up these videos in the recorded format, I have a request to make, as I did in the part 1 of this video, that I would request you to create the timestamp. Don't create the timestamp of particular question, just the name of the chapter and individual topic in that particular chapter is what I'm expecting you to do the timestamp for. Please, if you can do it. Yes, so let's start with the mutual fund NAV calculation. Let me take you all to the OutNotes. So one more thing, it takes some few minutes of disclaimer and the 6 hours of video. We are going to use 2 files in this. One is the concepts notes, calling it to be the OutNotes. Second is the question bank, calling it to be the OutScanner. Let me just show you both of those files, right? This one, people in the class, is OutNotes, which has all the concepts presented for you people in terms of tables, graph, timelines, charts. For example, if you look at this book, right? Just one second. Just one second. Perfect. Perfect. So if you look at this book, this is the chapter of mutual fund, right, which we are going to use. So these are the same notes which a regular batch student refer to, right? They are the same notes where all the things have been explained to you in terms of tables and charts rather than boring text. Another book that you're going to use in this question is this question bank. This question bank, people, has compilation of all practical questions from RTPs, MTPs, exam paper, study material, practice manual. Both of these notes you can download free of cost, right? The question bank, you can also order the hard copy. Yes. So now we are everyone in the class getting started. Perfect. Sir, going ahead with the basics of mutual fund, right? Everyone, please pay attention. The scheme, the way the mutual fund works is really simple. These are the investors in the market. They give their money to the mutual fund. They invest their money in the mutual fund. The mutual fund, against those investment, issue the units of mutual fund to these people. What are these people called as? These people are called as unit holder. The mutual fund, once they have the money, they invest in different kind of securities like share, bond, treasury bill, or any other security. They may keep it in cash. The first calculation that you have to do is the calculation of value of every unit. So you have to please understand, when this unit holder give money to the mutual fund issue those unit. The day when the units are issued, they are issued at a price called as issue price, which can be different from face value. Just like how share has a face value, similarly the mutual fund unit also have face value. What is the relevance of face value? The relevance of face value is to calculate the dividend. Is it necessary that the issue price at which the units are issued to the unit holder, that price will be exactly equal to the face value? The answer is no. It can be different. Now, once the units are issued at a particular issue price, right, and mutual fund has invested those amounts to different security. Now, every day when the market value of these assets, these securities will change, the total value of all the assets of the mutual fund will change, and accordingly the per unit value of the mutual fund will change, right? For example, today when the investment is made, the units are issued at a price of rupee 25. Mutual fund decided to invest 25 rupees in different securities. 5 days later, it may happen that the total value of all the shares in the market, all the shares, bonds, everything that the mutual fund hold become 29. So that is how the value, for example, there is just one unit issued by the mutual fund. So the value of one unit will become 29 after 5 days. What is the relevance of this 29? First, it is used to first it is the NAV of that particular day. Now look at the relevance. People, I am trying to be exam oriented. I am trying to focus on the applicability of the concept now. Right? Listen to me. Sir, 5 days later, someone else in the market goes to the mutual fund asking to invest in one particular unit. Please, you will have to tell me, everyone in the class participate. The mutual fund is going to issue the unit at an original price of 25, which was the NAV 5 days back, or is going to issue the unit at a price of 29, which is the NAV today. Is my question clear to you all? When the mutual fund goes to the unit holder goes to the mutual fund to invest in the mutual fund, what is the price at which every single unit of mutual fund will be issued? Units will be issued to that unit holder. NAV of 27, which was 25, which was the NAV 5 days back, or NAV of 29, which is the NAV today. So obviously, sir, the units of mutual fund are issued at a NAV of that particular day, meaning to say, what is the issue price of an unit, right? What is the issue price of a mutual fund unit? Sir, whatever is the NAV of the date of issue. Now, taking all to the formula of NAV, it simply says whatever assets that a mutual fund has minus the liabilities is the net total assets that mutual fund has. Who has the claim over the assets of the mutual fund? The unit holder. So when you divide it with n, which is the number of unit, you automatically get, people in the class, the per unit NAV of the mutual fund. Correct? Now suppose an investor goes to the mutual fund saying that I want to invest in you 1 lakh rupee, and the issue price become the NAV of that day, for example 29. So 1 lakh divided by 29, everyone in the class, will get you the number of units to be issued by the mutual fund to the unit holder. Are you people able to understand two basic things? Requesting very quick your responses, yes or no. And those who are watching up this video, let me tell you, the video is going to be very effective, very efficient. In the least time you will cover the most important things. What I expect from you, that if you are new to the channel, please subscribe this channel. Two more things: you have to please like this video. It motivates me that I'm doing good things for you. Second, you will have to ultimately comment down how your experience with this video was. Yes. So can I, everyone in the class, proceed ahead? Some people have already liked it, so that's really great. So now let's go to the practical question. So I'll go to the particular file called as ABC analysis. So for every attempt, for every attempt, you people know we have this file that we use called as ABC analysis, right? Just give me a second. Just give me a second, people. Perfect. So you guys know for every attempt we have this file called as ABC analysis, which has question wise categorization into A, B and C. So in this video we have to solve a category question of these particular highly repetitive topics of mutual fund. So I will very first go to which particular question. Now let me give you one more thing. Suppose you are watching up this video, for example, say for the attempt of November 26, right? When you order the book or when you download the soft copy of the question bank, you'll get the latest question bank, right? But the video that you are referring to right now is made using May 26 question bank. So both the video, like the video is going to be relevant for you obviously, and the notes that you've got is the latest notes, right? Now it may happen that this particular question that we have to do, for example, the first question that we've decided to do is question number 7. So it may happen that in the latest question bank, you may find this question to be question number 6 or question number 8. It doesn't mean that the book is irrelevant or this video is irrelevant. Everything is perfectly fine. You just have to make sure that you are looking at this particular question. Now, whether that is question 7 or 8 or 9 or question 6 in your book. I mean, consider one or two questions here and there. Perfect. Shall we all proceed with the practical question? Yes, come on. Question number 7 is the first question we are going to do. It is a comprehensive question on calculating NAV. Sir, question number 7. So those who are lagging behind, please make sure you all come to the latest live point where the class is going on. All right. Sir, question number 7, asked by the institute in Jan 26. Stock Capital is a SEBI-registered mutual fund launched its new fund offer on June 1, 2024 with a face value of 10 per unit. The fund received a subscription of 180 lakhs units. Sir, NFO is like an IPO, just like how a company issues its shares for the first time. Similarly, when the mutual fund issues its units for the first time, it is called as NFO. So on 1st June, they came up with an NFO with a face value of rupees 10 per unit. Sir, what is the issue price? If the question is silent, you can assume it to be the equal to face value. However, if the question is is specifying a issue price to be an amount, you have to accept that amount. Cool, sir. So the fund received subscription for 180 lakh units. Fine, sir. An underwriting agreement was in place with the Griffin Securities, which agreed to underwrite the entire issue of 200 lakh unit at a commission of 2%. So when the mutual fund issued 200 units, people in the class public could subscribe only 180 lakh units. But they have this underwritten subscription with another company called as Griffin Security, where that company said even if the security remain unsubscribed, right, the units of the mutual fund remain unsubscribed, we will subscribe to those units, for which the Griffin will charge 2% of commission. 5. Other expenses are summarized below. The initial investment in the capital market investment is 1780. Whatever amount the mutual fund got, 1780 was invested in different capital market securities. With respect to the new fund offer, expenses for marketing were 25 lakhs during the financial year 31st March 25. One second, we started on 1st June 24. Now, after 10 months, which is 31st March 25, the fund during these 10 months, the fund sold security of 250, security with the cost of 250 for 280. Listen to me. When I bought these 1780 securities, right? So from this 1780, the securities whose costing were 250 were being sold for rupee 280, right, lakhs. The fund subsequently purchased the securities for 265. After selling the funds, after selling the securities, I also purchased the securities for 265 lakhs. Management expenses are regulated by SEBI and cannot exceed 0.5% of average fund invested. Whatever amount has been invested by the mutual fund in different securities, of that average investment, my expenses that a mutual fund incur cannot exceed 0.5%. This is what the SEBI regulation is, right? The actual, so 0.5% of average fund investment during the year. The actual management expense incurred were 5.5 lakhs, of which 50,000 is outstanding. The total amount spent is 5.5, of which 50 is yet to be paid. 5 lakhs have been paid. Dividend earned on the investment is 5 lakh, of which 40 is yet to be collected. So 40 become accrued dividend receivable. 4.6 lakh is the dividend actually received by the mutual fund from the shares that is invested in. The fund policy is to distribute 80% of realized earning. As a mutual fund has realized two earnings. First is this capital gain of 30 lakhs, and second is this dividend of 4.6 lakh received. So whatever is this realized earning, 80% of it has been distributed by the mutual fund to the unit holder. Sir, what are you talking about? Let me take you all to the concepts notes for a minute. Just give me a minute. Just a second. Sir, we talked about unit holder investing in the mutual fund and then mutual fund making those investment in the capital market. Now these shares and bonds and treasury bills with the mutual fund hold will distribute interest and dividend to the mutual fund, and the mutual fund will distribute those investments and capital gain to the unit holder, and that is what they are talking about. The dividend 80% of the realized earnings were being distributed. Fine, sir. The fund policy is to distribute 80%. The market value of the portfolio on 31st March 25. Oh my God. On 31st March 25, on the day of expiry, we see that the investment's market value is 2150.50 lakhs. Determine the closing NAV per unit. My very simple question to you all is, for the purpose of calculating NAV, what all do you need? So you need all the assets of the mutual fund, you need the market value of all the assets of the mutual fund, you need all the liabilities, and you need the number of units. Can anyone in the class identify, or can you all people in the class collectively figure out what all asset do I have in this particular question today? Come on. Super ultra fast. On the day of maturity, what all do I have in my assets as the mutual fund? Someone will say, sir, we have the market value of portfolio on 31st March. All right, first. Second, what else? Someone will say, sir, we have dividend of 40,000 yet to be collected, dividend receivable. All right. Someone will say we have the liability of 50,000 yet to be paid. Agreed. Anything else? Can you all identify? Come on, come on. People, please come to the latest live point where the class is going on. You have to tell me anything else can you identify, is my question. The more you participate, the more you learn. You will have to, for that, think along with me. What else? In terms of asset and liability, is that all? So there is this practical tip that I want to give you. Whenever examiner give you the story of mutual fund right from the start, do you agree it gives you the story of mutual fund right from the day the mutual fund was born, when the IPO came? right? It means the examiner is giving you every information regarding cash inflow and outflow. So once you have the information regarding cash inflow outflow, can you calculate the closing cash balance from this information? The answer is yes. And that is why people in the class, cash, you will have to always remember, is to be considered in such cases, even if the question is silent. Are you all aligned to me? So let's, sir, first of all proceed to calculate the closing cash balance. Sir, my opening cash balance is how much? 200 lakh units into 100 per unit give me 2000. So let me, give me a second. I will for a moment take you to the question, to the file called as new question by ICAI, because there we have a solution of this particular question. Just give me a minute. Just give me a minute. So you know that we have this file called as new question by ICAI, which has compilation of all new questions asked by the institute. Okay. So here we have this particular question with us and its solution. Just give me a second. Perfect. So question number 7. We started with the issue of units, which is 200 units issued at a price of rupee 10, everyone. So we have 2000 lakh received. Then we made the investment, we made a commission of 2%. So commission of 2% is equal to, everyone in the class, 40. Then paid 1780 to purchase the security, 25 as marketing. So 1780 and 25. Then we paid the, then we received the, when we sold the securities of 250 for 280 lakhs. Now my question to you all is, people in the class, please participate and answer the question carefully. Now in my inflow, what should I consider? Should I, in the cash calculation, what do I consider? Is it 250 of cash outflow? One. Second, is it 280 of cash inflow? Third, is it 30 rupee of capital gain as the cash inflow? What do you think I should consider? Aman is saying, sir, here I'm here to ask you one question. Do we need to just go through all the questions or try to recollect answer first? What to do in one point? Sorry to disturb. See, Aman. For those LDR A category questions, you should try to arrive at the solution, right, of initial questions. If you feel that you are able to come to the solution of the initial questions, which means you have a feel, you have a rhythm of how to proceed ahead, then for the coming questions, you can just imagine the solution and confirm that your imagination was correct and accordingly proceed ahead. Cool. So everyone, you all must realize, back to the original question, you all must realize that it is 280 rupee of overall inflow that I need to consider, because I'm not calculating my income or anything. I'm calculating the total cash inflow, which gives me 280. Then I'll have to consider the purchase of security of 265. That's done. Then I'll have to consider the expenses. Now with respect to expense, we have to make one more note, because actual amount spent is 5.5, of which 50 is yet to be paid. But is it within the limits or not, that we will have to check. So let's go back to the amount of investment. I will say my opening amount of investment is 1780. So please understand, examiner does not say 0.5% of market value. It says 0.5% of amount invested, in that to average, means average of opening and closing. My opening amount invested was 1780. Then I sold securities worth rupees 250. Do you agree? Now the investment will reduce not by 280. The investment will not reduce by 280. It will reduce by 250, because I have to consider it on an invested basis, fund invested basis. So 1780 was the amount invested, then 250 the cost, the amount of investment which got redeemed, and the 265 again was my additional investment. So closing value of investment was 1795. So if this is my opening investment, this is my closing investment, what is the average of the two? It is 1787.5, of which 0.5% is allowed, which gives me 8.94 lakhs as the annual amount of expense being allowed. How much expense have I incurred particularly? Do you people observe? I have incurred only 5.5 lakhs. So is it within the range? Yes. Is it entirely allowed? The answer is yes. So I will consider entire 5.5 as my expense. In the cash particularly, I will say the management expenses is negative 5 lakhs. correct? Because 50,000 is my liability yet to be incurred. Then I will say the amount of dividend received is 4.6 lakhs, so that's my inflow. And then the amount of dividend distributed, so 30 lakhs is the capital gain, 4.6 is the dividend received. So 34.6 into 80% give me 27.68 as the outflow. So right from opening cash balance, if I consider all the inflows and outflows, the closing cash balance that I get is 141.92. In this question, my primary thing was to calculate the closing cash balance, because everything else is then easy. I will say the closing value of security is 21. It is 21. Where is that? 2150.50. That's done. Sir, the closing cash balance is 144.92. The dividend to be received is 40,000. The management expenses to be payable is 50,000. That's how the total net asset value is 2292.32. Divided by the number of units which people in the class we know is 200 lakhs, give me 11.46 as the amount of net asset value, which is NAV. Requesting every single live student sitting here, how much 10 are you out of 10 are you people settled with this question that we've discussed? Super ultra fast. How much out of 10 are you people settled? Could you understand the question? Could you understand the application of this? I mean, application of the concepts to this practical question. Super fast. In the initial few questions, you need to validate to me your understanding first. Second, at this point, we have a scope of changing the approach. Are you people comfortable with the language? Are you people comfortable with the flow, the rhythm of the class? Arjun, yes. Bhuvi, yes. Christy, yes. Everyone else, Chandu, are you listening to me there? Yes. Mugund, yes. Pratyush, yes. Tushar. Dividend already, Tushar, 5 lakhs is the amount of dividend total. 5 lakhs is the dividend earned, on which 40 is yet to be received. So in the dividend received, we have considered only 4.6, which is received in cash. Rest of the 40,000 is considered as dividend receivable. Could I answer your question? Istar sorted, Chandu sorted. Everyone else, great, great, great. So let's proceed ahead. This is how this particular question number 7 was. Now I will give you some guidance with respect to other NAV calculation question. This is question number 3 out here, right? Which give you the information regarding the securities that the mutual fund has on 1st Feb and 2nd Feb. Now my question to you is, on 1st Feb, if they ask you to calculate the NAV, do you agree if the mutual fund has 4 units? So we will find out if the mutual fund has 4 different securities, we will find out the total market value of all these 4 securities. We will multiply the number of share with the market price per share to find the total NAV of the mutual fund. Divided by the number of unit of the mutual fund will give me per unit. Divided by number of units will give me the per unit NAV. Perfect. So we have Rahul Satyaja sir here. Great sir, nice to see you. Very happy in fact to see you. What's going on, sir? Are you giving time students to study group 1, or are you still taking your DT marathons back to back? So we have Rahul sir here, everyone, who takes marathon and DT. He has continuously been taking marathons for different chapters in Hindi and in English languages. So you all must refer to his videos, and then you will get to know the efforts he is making to make your life easy. Are you all there? Guys, Rahul sir, are you listening to us? So back to the point, guys. So we have the NAV per unit. Now the examiner says, suppose a particular person at the end of 1st of Feb, people in the class, at the end of 1st of Feb, when a investor goes to the mutual fund to make the investment, what is the price at which units will be issued to that particular investor? People, that price is the NAV of that day, which you calculate on 1st of Feb. Could you understand this particular line? So I'm saying on 1st of Feb, the number of share and the market price has been given. Accordingly, I find the market value. So if this is my total market value, dividing by the number of units gives me NAV. Now the point people in the class are, suppose an investor goes to the mutual fund saying that I want to invest 30 lakh rupee in the mutual fund. What is the price at which the units will be issued to the unit holder, that person? So on 1st Feb, if the NAV people in the class is 78.8367, this become the issue price. So 30 lakh divided by this NAV tells you the number of units to be issued to that particular investor. Requesting your responses, could you understand what is the point of learning in this particular question? So I will make you people do all the category A questions. At the same time, I will give you a sense of what other question has point of learning. Then we have this question, which is also a great question, question number 4, which make you calculate NAV in a very different manner. This is B category question, as I already said, where examiner gives you Sharpe ratio and Trenor's ratio, where you will have to reverse calculate the beta of the security and then solve the question. Right? A reverse calculation question of mutual fund, question number 4. Right? Then we have question number 7 already done. Then we have question number 8. I will specifically tell you the point of learning in question number 8. Are you all ready? Shall we all proceed ahead? So we have Rahul sir, you're there. Pratyush, yes. So Tushar, you refer sir for DT. All set for it. Great guys, perfect. So y'all listen to me. Eighth question, what is the point of learning here? Eighth question has the similar story. They come up with a new fund of offer. 10 lakh unit of 10 each has been issued. Now they will say they have made the investment in different securities. Now read these lines. During the dividend of 8 lakhs were received, interest on all type of debt security was received. So mutual fund invested in equity, they received the dividend. Mutual fund investment in bond, they received all the relevant interest and everything. What is this information about? This information is about the cash inflow of the mutual fund. So using opening cash and then this investment and then this inflow, you'll be able to calculate the closing cash. Now what is the point of learning is what I'm specifically reading. Sir, on 31st December 21, on year end, equity share appreciated by 15%. So price per share was 320, which if increased by 15%, we get the closing value of 320, 320, 320 plus 15% give me 368 become the share price. Now, another learning is on 15th December, which means 15 days back, in AGM, the company XYZ, this company in which we made the investment, in declared an interim dividend of 10% and bonus share at 1:10 with the record date of 28th of December. So on 28th of December, which is the record date, you can understand it as on 28th, everything got executed. This interim dividend got paid to the shareholder and the bonus shares were issued to the unit holder, to the shareholder. So in this company where I made the investment in XYZ, I had initially 25,000 shares. Do you agree with the bonus? I will get one more share against every 10 share. So on 25,000 share, I will receive from the company 2,500 more shares, making the total to be 27,500 shares. Where price per share has increased by 15%, making the closing price to be 368. So now on the day of expiry, I mean at year end, I will have price per share to be 368 and the closing number of share to be 27,500. That is how when I calculate the closing, the market value of equity share, these are the two things I will multiply and that's how I will get my closing market value of shares. Requesting your responses, could I explain to you the particular part where we have the share price increase as well as the number of share increase? If you say yes, I proceed ahead. If you say explain more, I can happily repeat that, but you will have to please validate first. Come on. Requesting, could you all connect? So overall, everything else is fine. The point that I wanted to make you people understand, I have explained, which is with respect to the increase in the share price as well as the increase in number of share and accordingly get the closing value of the equity. Are you people clear? So the intent is to teach you the point of learning from every different question. So that is how eighth question is there. Eighth question is different. Right. Now. This is learning the practical questions, learning the concept as well as solving the practical question where we calculate NAV. Now I am everyone in the class taking you. Now I am, just give me a second. taking you all to the next concept, right, which is calculating the mutual fund return, calculating the return being earned on a mutual fund. Perfect. So time stamping people, a gentle reminder, can you please mark this down as the next topic, and we are starting with it. Sir, in the concepts, let me tell you, as a unit holder, from whose perspective is the mutual fund return calculated? Sir, from the perspective of unit holder, where unit holder makes the investment, right? He makes the investment called as NAV0. And what he gets against that investment is first dividend and capital gain, which is distributed to him. And the income which is not distributed to him is automatically reflected in the NAV1 with the mutual fund. So at the start of the period, the amount of investment you make is NAV0. At the end of the period, the NAV that prevails in the market is NAV1. And the difference between NAV1 and NAV0 is the capital gain with the unit holder has earned. So that capital gain is unrealized, but automatically what become the formula people in the class of the gain loss calculation is, of the return calculation is, NAV1 minus NAV0 is the capital appreciation that the unit holder has earned, which is unrealized in nature, plus dividend and capital gain which it has received in cash from the mutual fund. So as a unit holder, this is unrealized, this is realized, this is the total gain return earned in the numerator against the investment made in the denominator at NAV0. This is how much the return has been generated over my holding period. If my holding period is 9 months, so this is the capital appreciation of 9 months, this is the dividend and capital gain received in the 9 months, right? And this is entire percentage return of my holding period. But now you will have to learn to annualize it. How do you annualize it? Even if the examiner asks for effective yield, you don't have to compound it, you have to simply annualize it using simple interest, that whatever is my holding period return, that multiplied by 12 or 365 divided by n. So 12 divided by 9 month, or 12 divided by 3 month, or 365 divided by 90 days, 91 days, whatever be the case, right? So that everyone is, how do you annualize the return of the mutual fund? Sorted, are we all? Sir, in certain instances it will happen that examiner will give you the information regarding present value factor, future value factor. If that information is given and then the examiner asking for the return, then in that case you will have to consider compounded also. In that case you will have to give the two types of annualized return. First, simply annualized, another is compounded annualized. Sir, which are those situations and how do you do it? I will take you to the practical questions where this compounding is to be done, and then I will explain what is done there. Perfect. For now, are you people clear what is this formula of holding period return? How do you annualize it, and when do you compounded annualize it? This much, requesting your responses. Are you people clear? If you say yes, I'll immediately take you to the practical question. Just give me a minute. Let me have water in the meantime. Y'all please respond. Just give me a minute. Perfect. There are you all people. One second. There. Shall we all proceed? Now, sir, let me tell you what happens. So, everyone, examiner will make us do multiple things. First possibility, it will give you NAV1, NAV0, dividend, capital gain, and N. N is my holding period. The holding period you might have to count in terms of number of days. I'll take you to the day counting rules and the basics of AFM, right? And using these things, using NAV1, NAV0, dividend, capital gain, and you will be needed to calculate the holding period return, or I can say you'll be needed to calculate the annual return. Perfect. Now, it may happen to us in the exam that annualized return is given to us. Sir, NAV1, NAV0, dividend and capital gain is given to us, and we might have to reverse calculate N. Do you agree in a single equation, if there are 5 variables in total, then if any 4 are given, then fifth one you can calculate. Yes or no? Quick. If annual return is given along with NAV1, NAV0 dividend, can you not reverse calculate the N in the formula? The answer is yes, and that is what one of the types of the practical question is. So I will in this video not only teach you the concept, also try to teach you specifically the application of those concepts the way we just discussed it. So I will now take you to a situation where you have to learn to calculate return. Let's start with this very basic situation in question number 9, which is a B category question, one of the favorite of the institute, where the return calculation has been learned, right? Sir, K has invested in different mutual fund A, B, and C. B and C we are not focusing on, we are focusing on A. The date of investment, people in the class, is 1st December 18. Amount of investment is 5 lakh. NAV on entry date is 10.5. Dividend received up to 31st March 19 and 9,500. NAV on 31st March 19 and 10.4. You have to calculate effective yield considering 365 days. Even if it says effective yield, we know that we have to calculate simple interest annualized rate of return. Perfect. Sir, do you have the opening NAV? Yes, sir. Do you have the closing NAV? Yes. Do you have the amount of dividend? 9500. Now you need to either convert to dividend to per unit so that opening and closing NAV are per unit, or you need to convert to the opening and closing units, now closing and closing NAV to totality basis. So I will say amount of investment is 5 lakh divided by opening NAV is 10.5, giving me the number of unit as 47619.048. You have to do the calculation till 3 digits after the decimal point. So you have the opening number of unit as 47619. If my closing NAV is 10.4, how much is the closing amount of investment become? 47619 unit multiplied by closing NAV, you get the amount of investment as 495,238. So how much is NAV1? 495,238 minus how much is NAV0? How much is the amount invested initially? 5 lakhs. And how much is the amount of dividend received? 9500. Using this, can you all calculate the rate of return being earned? The answer is yes. Just give me a second, please. Just give me a second. Perfect. Cool. There. Yes. So, sir, opening is this, closing is this. So, closing minus opening plus the dividend of 9500 divided by opening will give you the rate of return. But that is my holding period rate of return. How many number of days have I held the investment? Now, please understand something about the accounting rules. Generally, the rule is that suppose if my opening date of investment is 15th December till 31st March, you don't count 15th. Your first day of investment is counted as 16th. So from 16 December to 31st December, you take the number of days and accordingly you take it till 31st of March. But when the date, my start date is start of the month, like 1st Feb, 1st December, 1st Jan, for example, then in that case, you also count first as well as the last date. For example, in this case, I will count 1st of December as well as 31st of March as my last date. So let us super ultra fast calculate the number of days. So can I say I will have 31 days of December plus 28 days of Feb plus 31 days of March. So I will in total, people in the class have, sorry, Jan I missed. I will have from 1st of December, I'll have 31 of December plus 31 of Jan plus 28 of Feb plus 31 of March. Right, give me 122, 121 people in the class as the number of days. So if you have everything now, calculating return is not a big deal. It is like NAV1 minus NAV0 plus the amount of dividend of 9500 received divided by NAV0 into 365 divided by 121 give you the effective yield per annum, which is in 3 digits after the decimal point. It is 282.859. If you are not comfortable, you don't have to make this table. You have to simply apply the formula that you've learned in OutNotes. Requesting your responses, I'm giving you 15 seconds to do it. Please do calculate it at your own. So I will say 495, 495,238.099 minus 5 lakh plus 9500 divided by 5 lakh is 0.00947 into 365 divided by 121. Give me 0.02859, which is 2.859%. Do you all have calculated it? Do you have the answer ready, people in the class, with respect to mutual fund A calculating the return? The main question that I want to teach you, people in the class, is question number 12, which is a reverse calculation question of NAV. Yes, 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 yes. Right. So let's now look at the main question we are trying to look at. Mr. D has invested in the three mutual fund. In the first mutual fund, the amount of investment is 2 lakh rupees, where NAV at the time of investment was 10. Sir, how many units must have been allotted? 2 lakh divided by 10 give me 20,000 unit. Then dividend yield up to 31st March 22 is 3%. Sir, what we have been given is the yield of the dividend. NAV on 31st March 22 closing NAV has been given, and annualized yield per annum has been given. Do you observe what is the point of difference in this question as compared to the previous one? In this question, annualized return has been given. In the previous question, it was being asked. But in the previous question, opening date of investment was being given. In this case, the opening date of investment is not given. Do you all first of all identify where is the difference? Which means in this case, this n, the number of days of investment, is missing where the return has been given. So is this a question of reverse calculation? The answer is yes. Sir, let me try to first of all teach you the holding period, the main part on which I want to bring your attention to. So they will say the number of unit allotted is simple, 2 lakh divided by 10 give me 20,000 unit invested. The value of investment on 31st March 22, so if you have 20,000 securities where every security is worth, every unit is worth 10.5, so 20,000 units into 10.5 give me the closing value as 210. Now bringing you all the formula of return, because I need to find out the holding period. What it says, the holding period formula says, you have to now listen to me carefully. The formula says here it is. Can I say the formula says NAV1 minus NAV0 plus dividend divided by NAV0, right? Whole multiplied by 365 divided by n multiplied by 100 is equal to return. Agreed? Is the return given? Yes. Is the opening and closing NAV given? Is the dividend amount given? The answer is no, because dividend yield has been given, not the dividend amount. Sir, in that case, how do we solve it? Is really simple. This box I can break down into two parts. How can I break it down? One part will be NAV1, right, minus NAV0 divided by NAV0. This is first part, NAV1 minus NAV0 divided by NAV0. The second part is D divided by NAV0. Are you understanding how am I breaking it down? So D divided by NAV0 is considered as dividend yield, where NAV1 minus NAV0 divided by NAV0 is what we can calculate. So overall, effectively, how does the formula will look like? So it's like the amount of return is NAV1 minus NAV0 divided by NAV0 plus the amount of dividend yield given in the question as 0.03 into 365 divided by n is the amount of return. Now, if you multiply here, you can consider the return to be in percentage terms, which is 9.73. However, if you don't multiply 100 here, then you will have to consider the returns in decimal terms. Now, if you solve this entire equation, do you realize only one number in this equation is missing, which is n, which if you calculate turns out to be 300 days. In this video, I'm not going to teach you how do you do the calculator, but the answer of that will come out to be 300 days. Requesting your responses, people in the class, please validate. Could I explain what this question is about, especially this particular part? Come on. Super ultra fast. Every live student watching up this video recorded, people, you all need to please validate it to me. Am I able to explain this to you? What do you say? Are you all aligned to me on this? Settle, please. So this question involved calculating the holding period, and the next immediate point of learning was date of original investment. Sir, on 31st of March 22, if my holding period was 300 days, then what was my date of investment? The calculation is really simple. You have to take 300 on the calci. From the 300, let's deduct the month in a reverse chronology. From 300, I will deduct 31 days of March. Then I will deduct 28 days of Feb, 31 days of Jan, 31 of December, 30 of November, 31 of October, then 30 of September, 31 of August, 31 of July. So I'm left with 26 days. Till July, I have eliminated everything, which means now I'm standing on 30th of June. On 30th of June, when I stand, my holding period is just 26 days. So now I will say 30 days of June minus 26 days of holding period give me 4th of June as my start date, which is my investment date as my 4th of June here. So the things that we have discussed in this question, I'm not discussed the entire question because F and G are the rare part. This is something you'll have to do at your own. But the primary part on which majority of your marks will be based and which have been asked by the institute in multiple times in different format is what we have done. Settled are we? Settled are we? So that was question number 12, a reverse calculation question. Then we have another question which is based on the dividend reinvestment plan. Give me a minute. Give me a minute. Just hold on. So guys, first you have learned the question on NAV calculation. Then you have learned the calculation of NAV using the mutual fund return formula that we just did. Now you are focusing on dividend reinvestment plan. Let me explain to you what exactly that particular plan is, and accordingly you will realize what kind of questions institute ask. Right? So time stamping people, a reminder to you, if you can help us with this time stamping, please do it. Guys, reinvestment plan. Please try to understand it right from the basic. When we make the investment in the mutual fund invested that amount in different securities. The mutual fund received the amount of interest and dividend from different securities, and mutual fund can distribute that amount to us in cash. That is what we have learned. That was one particular kind of plan. Now we have one more kind of plan here, in which what happens is that the amount of dividend that the mutual fund is planning to distribute to us, he doesn't distribute us in cash. Rather, mutual fund assumes that same amount will be reinvested back in the mutual fund, against which the units will be allotted to the unit holder. Do you understand this basic? So the amount of dividend is automatically assumed to be reinvested in the mutual fund. Sir, what will be the rate at which the reinvestment will happen? Sir, that is the issue price, which is the NAV of that day. What become the issue price, people in the class? That become the NAV of that day. So the day NAV, what on that day, whatever is the NAV, that become the issue price, and accordingly the units are allotted to the unit holder based on the amount of dividend. Which means you have to please realize that in case of dividend reinvestment plan, will the number of units change? Yes, opening units, if is 100, then closing can be 110, 115, whatever. So in that case, if you want to calculate the return, you cannot do it on a per unit basis. You cannot calculate the return ignoring the effect of units. You have to calculate the return in that case giving the effect of units. Do you agree? In case of dividend reinvestment plan, nothing is received in cash. So the formula automatically become closing NAV into closing number of units. So if I have the units and NAV given to me, if I have the opening NAV and the opening number of unit, I will get totality closing NAV minus opening NAV on totality divided by opening NAV on totality, give you the percentage return made as the holding period return. Now, if you have to annualize it, you can annualize it using simple interest or with the effect of compounding, which is something you've already learned. Correct? Requesting your responses. Now sir, how do you find the closing number of unit? That is the most important question. Let me tell you, any question of dividend reinvestment plan will be solved using only these two formulas. One, the formula of return that you are looking on the screen right now. Another is the simple formula which I'll speak right now. Sir, you have to always remember, for a particular period, the closing number of unit is simply whatever were my opening number of units multiplied by the units which got reinvested. For example, imagine that I have 1000 units right now of NAV 10. Suppose company distributes 20% dividend. So opening NAV was 10, opening face value was also 10, dividend is as a percentage of face value. So 2 rupee of dividend will be distributed on 10% of face value. So on 1000 rupee, 1000 units, I have 2000 rupee of dividend being distributed. Is that received in cash? No, sir. On that day, suppose the NAV is 25. So I have been received, I will be receiving, people in the class, units against those dividend, against that amount of dividend. So amount of dividend is 2000. NAV on that day is 25. How many units will be allotted to me is 80 unit. So if I have the opening units as 1000 and the units further allotted for that period as 80, then the closing for that period become 1080. Right? Now you have to understand the next thing. Suppose next in the next slot, mutual fund distribute the dividend of 25%, which is 2.5 rupee. Now I will now, people in the class pay attention, receive the dividend of 2.5 rupee, not on the 1000 original units, because now my number of unit that I hold is 1080. So 2.5 multiplied by 1080, which is including this 80 units which got reinvested, I get the amount of dividend as 2700. On that day, suppose NAV become 30. So 2700 when gets reinvested back in the mutual fund at the rate of 30, I get 90 more units and the closing number of unit become 1170. And that is the closing number of units to be used in this formula out here as N1. People in the class, do you understand what the point everyone is going on here? So with opening units, along with the information of dividend and along with the information of NAV of that particular date, I can find out the units reinvested and accordingly the closing number of unit, and then I can apply this particular formula. Perfect. Do you get me? Hello? Bhuvi, you have to please understand dividend is calculated as a percentage of market value, but in mutual fund here, you will have to consider market value at 0 point. Okay. Your point is genuine, but let's not enter into this direction right now. Let's not, you have to just remember that in case of dividend or in case of derivative or in case of mutual fund, you will have to consider the price of opening point, the NAV of opening point in formula of dividend yield. Everyone else, are you people clear how does the reinvestment thing work? If the answer is yes, let me take you all to that practical question. Perfect. Sir, the first practical question that we are going to look at is question number 18, a reverse calculation question of dividend reinvestment plan. For which, give me a minute, I will need to open the handmade notes of our full English regular batch. Because in the full English regular batch, we did prepare the notes which will simplify this topic. So in the regular batch, we try to understand everything on timeline, and this question will can be easily understood on the timeline. So let me explain this. Let me start to read the question. Question number 18. Yes, MB Vlogs, the name. What's your name? MB Vlogs, what's your name? Just give me a second, guys. Let me have water, then we'll proceed ahead. Perfect. There. So let's proceed ahead. Sir, they say Messrs Corpus and AMC on 1st April 2015 has floated two schemes, dividend plan and the bonus plan. This question was first asked in November 20 and then in May 23. But similar question has been asked by the institute in Jan 26 in MCQ and in May 21 and people in the class in November 21. Right? These are the same patterns of question being asked. In first time when it was asked in November 20, there were some ambiguities which institute later on removed. So if you get to see in the exam now, if you get to see this question, if you get to see it as an ambiguous one, which is what we are doing in the class, if you see the question without ambiguity, the life is anyway sorted. So we are in this class solving that ambiguous question. So on 1st April 15, there were two schemes, dividend plan and the bonus plan. First ambiguity of this question is the examiner does not specify if the dividend plan is the dividend payout plan, which is paid in cash, or dividend reinvestment plan, right? What I'm trying to tell you is this particular thing. The formula that you learned here, the formula that you learned here was the formula of growth plan or dividend payout plan. The formula that you learn here is the formula of dividend reinvestment plan and the bonus plan. Now, when the examiner says dividend plan, we are confused whether that is payout plan or the reinvestment plan. So you will observe that this particular type of question, This particular type of question which institute ask always assumes dividend reinvestment plan. Sir, let's proceed ahead. You will understand it further. So there are two plans, dividend reinvestment plan and bonus plan. Mr. X, an investor, has invested in both the schemes. The following details except for the issue price are available. On the date of investment, which is 1st April 2015, I must have invested at a particular NAV. That was my issue price. The information regarding that is missing. But after that, on respective dates, people, dividend in percentage terms was being distributed and the bonus was distributed. And on respective days, the NAVs has been given. Additional details given to me is that amount of investment is 9,20,000 and 10 lakhs. Fine. Second thing is average profit earned in the dividend reinvestment plan is 27748 and the average yield earned is 6.4 percentage. First of all, do you observe that we have been given the information regarding the return? The return being earned here in terms of percentage, here in absolute terms, the return has been given. You are required to calculate the issue price, which is these two prices in both the schemes. As I said, any question of dividend reinvestment plan, it can be solved only those two particular formulas that I talked about. So, sir, simple ways, whatever has been given, let's try to apply the formula of it. Sir, have we been given the return? Yes. So let's apply the formula. I will say average profit being earned, right, in absolute terms, in not in percentage terms, is NAV3 into N3 minus NAV0 into N0. Sir, generally it is NAV0 into N0 divided by NAV0 into N0. But the profit has been given in absolute terms, which means it has not been it has not been calculated as percentage, which is why I am also not dividing it with the NAV0, which is NAV0 into N0. Sorted. Multiplied by 1 by n, because the given profit is the average profit of 5 years. This is how my formula I will have to modify. Now the point of learning in this question. Sir, what do you mean by NAV3? You have to please understand this particular thing. Sir, or what do you mean by N3? Do you agree that before this dividend, my first dividend was distributed on 31st March 2017. Before this dividend, suppose the opening number of units were N0. Then at this dividend, after this, at this point, some reinvestment will happen, and with the reinvestment, my number of unit will become N1. The same N1 unit continue to be there till the next dividend. On the next dividend, some units get allotted, and my number of units become N2. And then N2 gets continued, and ultimately the number of unit become N3. So the closing number of unit is N3 and the opening number of units is N0. The closing NAV is 49. So I will say average 40 is 27748.6 into NAV3 into N3. So NAV3 of 49 has been given, multiplied by N3, the closing number of units not been given, minus NAV0 into N0. Sir, what I ultimately need to find out is NAV0. NAV0 is what I ultimately need to find out. But do you agree, in this equation, if I see, I don't have NAV0, I don't have the opening number of unit, I don't have the closing number of unit, but I have the multiplication of these two amounts. Do I have the NAV0 into N0, which is the total amount of investment of 9,20,000? The answer is yes. People in the class, please participate. So if I have the average profit, if I have the closing NAV, which is NAV3, if NA3, the closing number of unit is missing, and if the opening totality investment is there, where the time period is 1 by 5, from this entire equation, only one thing which is missing, which is closing number of unit, can I find out? The answer is yes, which is 21067 unit. Now you have to please look at the reverse calculation. Till this point, on this particular thing, are you all people please settle? You have to respond to me. Please validate. I will take you all ahead, but please, you need to first of all respond to me with it. Are you people sorted with what has happened here? Are you people clear with the back calculation of closing number of units? Quick, yes, no, what do you all say? People, people, yes, no. Those who are watching up this video, enjoying this video and still have not liked it, guys, this is unfair. This is totally unfair. So 21607, Christy, I mean the writing mistake here and there is fine, but please understand what the thing is. Now, people in the class, let me tell you what this question is about. This question is about, imagine this timeline. In this timeline, you'll observe that first dividend was 31st March 17. So on 31st March 17, I have this dividend. Sir, whatever have been my opening number of unit, on that units, I will get this dividend, and accordingly, with the dividend units which got reinvested, I will have closing. My next dividend is 10% received on 31st March 18. So on 31st March 18, I'll receive the dividend on N1 units, which with this dividend become N2. The last dividend is 31st March 19. On this date, when I receive this dividend on N2 units, the closing with the units reinvested become N3. Do I have my N3 available with me? Yes, 21607 is available. Now you have to understand reverse calculation of N2 using N3. Meaning to say, just after this dividend, if the closing number of unit is N3, then immediately before this dividend, how much was N2? So can I say closing the opening unit which is N2 plus the units which got reinvested give you the closing unit N3. Perfect, sir. Let's N2 be N2 only. On those N2, the number of unit, how much is the amount of dividend being received? 1.5. So N2, the number of units multiplied by the amount of dividend per unit, whatever, this gives me the total amount of dividend when divided by the NAV of that day, which is 45. This total amount of dividend gets reinvested at what NAV? At the rate of 45. So N2 plus the amount of dividend, which is 1.5 into N2 divided by 45 being the NAV of that day, give me the closing number of unit of 21607. 21607. So 21607 is the units we have after this 15% distribution of dividend. So how much will N2 be, which is the units before dividend distribution? Give me this equation. In this entire equation, only one number which is N2 is missing, which is the units before dividend distribution, which turns out to be 20,910. People, requesting your responses. Are you please understanding? Chandu says, sir, so average profit is what is earned in the holding period of 5 years. So Chandu, that is the profit of 5 years, but averaged out, which means it has been divided by 5. Do you understand, Chandu, my answer? People in the class, do you get this equation? So accordingly, what do you get as N2? It is 20910. So I get the number of units to be here like 20910. So now you do the same calculation for the second dividend of 10%. I will say opening unit is N1. On that N1, if you receive 10%, which is 1 rupee of dividend on N1 units, which if gets reinvested at the rate of 50, then you get the closing number of unit as N2. Same formula gets applied again. People, sir, N1 plus N1 plus on this N1, if you get 1 rupee of dividend, which is 10% of 10 rupee face value divided by the NAV of 50, give you the closing unit as 2910, which you calculated in the last step. So accordingly, in this entire equation, only N1 is missing. That's how the N1 become 20,500. And similarly, N0 become 20,000. So please understand, can you directly calculate the closing unit N0 directly from the return formula? No. In the return formula, you will have to first calculate N3, right? Because you have this totality amount available as 9,20,000, which you can put as value directly, so that your N3 can be calculated. And using N3, you will have to reverse calculate the N0. Once you have the N0, you will say the total amount of investment is 9,20,000 divided by the opening number of units of 20,000, give you the NAV per unit or the issue price per unit to be 46. Requesting your responses, could I explain this reverse calculation question easily through this timeline approach that we use in the regular batches? Come on. Everyone, please validate. Could I successfully do it? I need your responses, people in the class, please. What do you all say? Quick. So if I could explain this, there is one more thing in this which I would want to explain is the bonus plan, right? So dividend reinvestment plan gives you unit, issues the units based on the amount of dividend. The units are based on how much is the amount of dividend amount, and that is also based on the NAV of that particular day, which gives me the units which got reallotted, which got reinvested. Perfect. Now I will have to, people in the class, sir, teach you the bonus plan. Bonus plan simply involves a bonus ratio, which says that suppose the opening unit you have is 1000. The bonus ratio is 1:5. It means it has nothing to do with NAV. On 1000, 1:5 bonus give me 200 units, which means now I will have 1200 unit. Suppose the next bonus is 1:6. So on 1200, 1:6 become 200 units. So the closing number of unit become 1400. So point of learning is that every subsequent bonus is on the units that you hold before that. Initially were 1000 units, so 1/5 of 1000 we did. Then was the bonus unit of bonus ratio of 1 is to 6, for which the units you will consider is 1200 not 1000. Accordingly, you'll have the closing number of unit. So the formula remain the same, NAV1 into N1, closing NAV multiplied by the closing units, which is inclusive of bonus unit, minus opening NAV into opening units divided by opening NAV opening unit. This is holding period. Then this is how you annualize it. So, sir, in the same question, do you have to also reverse calculate the bonus plan thing? The answer is yes. Let's do it. So I will say on 1st April 15, the bonus plus NAV is missing. But we did give the bonus ratio of 1 is to 4 and 1 is to 5 on 31st March 16 and 31st December 18. Accordingly, if the average return is 6.4, we will say it's really simple. Sir, the formula of return is what? NAV1, NAV2 into N2 minus NAV0 into N0 divided by NAV0 into N0 into 1 divided by 5 is the return. So 6.4 is the return. Closing NAV is 44. Yes. Multiplied by the closing number of unit, which is N2, minus opening NAV into opening number of unit. Everyone in the class is 10 lakhs, which is this particular thing here. So closing minus opening divided by opening into 1 divided by 5 into 100 give me the closing number of units as calculated is 30,000. Now if you have to apply the same reverse calculation concept, can I say 30,000 is the closing number of unit after the effect of these two bonus? So if this is N0, with this bonus it become N1, which continues here. Then with the second bonus it become N2. So please tell me how much will N1 be? How much will this N1 be? On that N1, if you get the bonus at the ratio of 1 is to 5, your closing become 30,000. So it's really simple. Sir, there is some units N1. On those N1, I get the bonus of 1 is to 5. And with the bonus, the closing become N2, which is 30. So in this entire equation, only N1 is missing, which if you calculate become 25,000. So units here must have been 25. Now the same question, how much will this N0 be? On which, if you get the bonus of 1 is to 4, it become 25. So N0 into, on that N0, 1 is to 4 bonus become 25. So N0 become 20,000 unit. So if your opening number of unit become 20,000, people in the class, the amount of investment divided by the opening number of unit give me 50 rupees as the issue price as the opening NAV, which got calculated in this bonus plan. Requesting your responses. With these broad topics that you are doing, you are significantly covering your chapter of mutual fund. If you all realize, you are only ignoring the one-off topics like dividend equalization, expense ratio, entry load, exit load. Other than those topics, you are covering almost majorly all the questions of mutual fund with the topics that we have discussed. Quick, how much out of 10 every single student watching me live is clear with this particular thing? Question number 18, please answer me. Come on. Super ultra fast live people, you need to respond to me. How much out of 10 particularly on question number 18? Next question is question number 19th, which is another brilliant question which we are going to solve again using timeline. So this is again the timeline explanation of the class notes in the regular batch, which we will follow in question number 19. So Suvarna, is that your first name? That's 10 out of 10. Christy, you're clear? Others in the class, come on, live people, if you're watching, what's happening? Are you people clear? Question number 19 is again about reverse calculating NAV using the dividend, using the return formula of a dividend reinvestment plan. Let me explain broadly what this question is. Now, I'm not going to explain this question entirely, but will give you only a sense of what this question does. What does this question do? On 1st July 2010, Mr. X invested 50,000 in initial offer in the mutual fund at a face value of rupees 10 per unit. So 50,000 was invested. At that point, face value was 10. Since the issue price also 10, which means NAV was also 10, which means the number of unit must have been allotted as 5,000. Cool. On 31st March 11, which means when this particular year ended, A dividend was paid at the rate 10% of face value, obviously. Annualized yield was 120%. Cool. Sir, on this date, when the dividend of 10% was being paid, how much amount of dividend was paid at the rate of 10%? For this particular period, if I calculate the annualized return, the holding is from 1st July to 31st March is only 9 months. But during this 9 month, if I calculate my annualized return, it people in the class was 120%. On 31st March 12, 20% dividend and zero point 0.6 of capital gain was given. Sir, now on the next year end, a dividend of 20%, so face value is 10 rupee multiplied by 20% is 2 rupee. 2 rupee of dividend plus zero point 0.6 of capital gain, which is 2.6 rupee, was people in the class was being given, right? Cool, sir. Fine. On 31st March 13, on 31st March 13, on the next year end, Mr. X redeemed all 6271.98 units where the annualized yield was 71.5. The point of learning in this question is how can you invest in 5,000 units and how can you redeem 6271.98 units? It is possible only when you have a dividend reinvestment plan or the bonus plan. Since the information regarding dividend has been given, you have to obviously assume it to be a dividend reinvestment plan. So now they say the closing number of units given to us is 6271.98. And when the units were these, we found the annualized return. My overall return during this period, the annualized return was 7.71.5% per annum. Calculate NAV on 31st March 11, 12, 13. 11, 12 and 13 you have to calculate the NAV. Do you people agree that generally NAV calculation require asset and liabilities, but obviously they are not being given? We have rather been given the formula of the details regarding the return of a dividend reinvestment plan. And now you all can connect. Obviously, in the formula of return, do you have the NAV, the closing NAV used in the formula? Yes. So if you have the amount of return available, can you not reverse calculate the closing NAV? The answer is yes, which is how we will have to solve this question. Are you all, before solving the question ahead, can you feel that whatever you learn in the OutNotes has this applicability in the practical questions in the OutScanner? We have to in the class focus not only on learning the practical question, learning the concept, but also applying the concept in the practical questions. Settled, are we? So how do I do it now? Sir, if the return is given, let's try to put a formula to it. Sir, if it is a dividend reinvestment plan, what all do you need? Sir, you need the opening amount of opening NAV is 10, the opening number of unit is 5,000. Cool. Sir, you have to find the closing NAV. So this NAV, which is closing, is yet to be found. Cool. Second, the closing number of units we have to find. Do you agree the closing number of unit has a simple formula, opening plus the unit which got reinvested? Now you have to pay attention. Sir, opening units for 5,000. On 5,000 unit, when you distribute 10% of dividend, it is 1 rupee. So the amount of dividend become 5,000 rupee. That amount of dividend of 5,000 rupee, people gets reinvested at the NAV of that particular day. So the number of units which got allotted automatically becomes what you have to pay attention. Sir, opening units were 5,000. The units that get reinvested is 5,000 divided by the NAV of that particular day. So closing NAV become this. Closing number of unit become 5,000 plus 5,000 divided by NAV1. Now we have to pay attention. Let's look at the formula. NAV1 into N1 minus NAV0 into N0 divided by this into 12 divided by 9 because we want to annualize it. 120 is the return being given. NAV1 is what we need to find into closing number of unit is 5,000 plus 5,000 divided by NAV1 minus opening NAV and the opening number of unit, which means the opening amount of investment is 50,000 divided by 50,000 into 100 into 12 by 9. Right. Now in this entire question, if you realize only one particular number is missing, which is NAV1, if you calculate it, you get 18 as the NAV1. And that is the first thing that question was expecting us to solve. So how have we solved NAV1? By reverse calculating the closing NAV using the return formula. People, do you connect to this? Now I'll take you to the next level. Sir, in the last year, has the information regarding dividend been given? In the last year, any information regarding dividend is given? The answer is no. On 31st March, you redeemed all the units. No information regarding dividend. So now there comes into picture an assumption, please pay attention. Since there is no dividend in the last year, which means was there any reinvestment in the last year? No. Which means can I say the closing number of unit and on 31st March 13 will be the same number of units on 31st March 12? Yes. So do you have the closing units of 12? Yes. Do you have the closing number of units of 11? Yes. Sir, how do you have it? Let me explain. 5,000 was the amount of dividend divided by 18 become the amount of 18 become the NAV of that day. So 5,000 divided by 18 give me 277 units which got additionally reinvested, giving me the closing number of unit as 5277.78. Do you understand? You can do it on the calc. 5,000 amount of dividend divided by NAV that we calculated as 18 give me 277 units. So at the end of first year, I have 5277.78 unit. Sir, for second year, if you observe the opening units, we have the closing units we have. Do you have the return formula of second year? No. Which means can you apply that and find the reverse calculate the NAV? No. Then what is the only option left? Do you agree the only option left with you is to use that second formula? What people in the class is that second formula? That second formula is the opening plus unit which got reinvested is equal to closing. Let's use the second formula. So I will say opening is 5277.78. On those units, I will get 2 rupee of dividend and 0.6 of capital gain. So on the opening, if I get this dividend and capital gain, the amount which gets reinvested become 13,722 divided by the NAV of that day. Whatever is the NAV, whatever is the NAV on 31st March 12, on the NAV of that day, when this amount of dividend, right, which is 2.6 rupee on this 5277.78 units, right, when this amount of dividend gets invested at this particular NAV that we need to find, right, along with the opening, that become the closing number of unit at 627.98. So in this entire equation again, which is opening plus invested is equal to closing, I have the only number missing is NAV2, which if I find out become 13.8. That is how I get the NAV of year 2. Boss, very easy. Very similarly, for year 3, the return has been given. So using the return of 3 years, you can back calculate the formula. You can back calculate the NAV of third year, which is very easy. First 2 years I explained in the class. Could I successfully do it? You all have to please respond to me on this, people. Your response give me a sense that whether all of you guys are able to connect to my thoughts here or not. Please tell me. Is that connection happening? So question number 19th gets done. There is another A category question which you all must solve is question number 23 at your own. This is category question. It also belongs to reinvestment plan. Some reverse calculations are involved, right? So when I say, listen to my words carefully, listen to my words carefully, people. When I say that mutual fund reinvestment plan questions have been asked 8 times, whether it is normal calculation or reverse calculation, which kind of questions have been included in that 8 times? The question that we just did, the question that we just did on the timeline, the question like this, the question of reinvestment plan and the bonus plan that we did, this particular question here, this particular question here, this one, and the question that you see here on the screen, which is question number 23, right, which is this question out here, question of Mr. Raj. So these are the questions that you all must, people in the class, solve. Sorted. So now with that, all the high priority topics as in more repeatedly topics of the chapter of mutual fund we have discussed, which is mutual fund reinvestment plan, NAV plan, and the return plan. Requesting your responses. Are you people aligned to me, settled with what we have to do in this chapter? Come on. We are done with the first chapter. If you are settled, please let me know. I will take you to the next chapter, which is the chapter of international financial management. So time stamping, people, you have a reminder. Have a reminder, please. We have to learn just two simple things. Question of international capital budgeting and question of ADR GDR. Please tell me. Can we all proceed ahead? Sorted? Are you people finding this marathon to be fruitful? Yes. Sorted. I think I should have posted a message here. One second. I cannot edit my message. So, anyways, cool. Let's go. Perfect, sir. Moving to the chapter of international financial management, where we see these are two particular topics which are highly repetitive, which is one is international capital budgeting and second is ADR, GDR. Let me take you all first of all to the concepts notes, right? Where I'll quickly make you people understand the concept. So we have international capital budgeting in the chapter of Forex, right? So name of the chapter is Foreign Exchange and International Financial Management. So IFM is that chapter where we have this topic called as international capital budgeting. If you understand it on the timeline, you'll find it really easy. So please pay attention to the concept. Sir, detailing, pay focus, pay attention to the detailing. All right, just give me a minute. It's so hot here that even if it is 8:30 in the evening, I am feeling thirsty again and again. Just give me a minute. Sorted? Shall we all? Perfect. So, what were we doing? Learning international capital budgeting. So you have to please understand what happens in the international capital budgeting project is that you are in India, your home currency is rupee, right? But you want to invest in a project which is in US. So now your amount of investment has to be in dollars because in US, what is the currency? Dollar. When you make that investment, when the project starts to do the operation, the cash flows which are generated, the inflows that you have will also be in dollar, but what you ultimately need is rupee. So there is a very simple way to do it. Sir, when you need to make an investment at 0 point, that is in dollar. When you receive the cash inflows against it, people in the class, that is in dollar. So when you need a dollar, you will have to go to the forex market to buy dollar. At what rate will you do it? So obviously when that happens at 0 points, so spot rate become applicable. So accordingly, to buy those dollars, what will go out of your pocket is rupee, which is home currency, based on the spot rate. So this red color represents the outflow. Outflow of dollar is needed to be bought at a spot rate, and accordingly what I'll pay from my pocket to buy those dollars is my home currency, which is rupee. Now I will receive the dollars. I will receive the cash flows against the investment that you made initially. Yes. So when you receive something, the next step is to sell it. You will sell these dollars in the forex market at the end of respective year. What is the rate at which that selling will happen? That is either the forward rate of respective year end or the spot rate of respective year end. Accordingly, when you sell those dollars in the forex market at the respective rates, you will get the amount of rupee received. So ultimately, to buy those dollars, there's a rupee outflow. When I sell those dollars, there are rupee inflow. So can I say effectively I have the rupee outflow and rupee inflow related to that particular project? And now this question become the question of C, intermediate. Initial outflow rupee, annual inflow rupee. You have to discount the annual inflow at a particular discounting rate to get the present value of inflow. Deducting from it the initial outflow will give you the NPV in your home currency, which is rupee terms. Could I, people in the class on the timeline, explain this concept? Now you have to focus why is timeline important. When I say buy, you have to please figure out the rate, as in When it is at 0 point, there is a spot rate applicable. Second, when you have to buy it accordingly, in your mind, there should be clarity of bid ask. Buying dollar will require whether the bid rate or ask rate that you can figure out in the question. And last thing, when you buy dollar, ultimately what goes out of your pocket is home currency, which means it is a case of home currency outflow. Similarly, the green color represents the inflow, which means you'll have to sell them, giving you a clarity of bid versus ask rate. Also, it is at the end of respective year, giving you a clarity of respective forward or spot rate. Perfect. Sir, that is how you can calculate NPV. This is called as home currency approach. There is one more option called as foreign currency approach. If the question is silent, you will have to primarily apply home currency approach. Foreign currency approach involves calculating the NPV in terms of dollar only, which means rather than converting the cash flow, inflows and outflows from dollar to rupee and then calculating NPV, let's first calculate NPV. If you have the amount of investment in US in dollar and the amount of inflows from that project in dollar only. So dollar outflow and the dollar inflow can give you dollar NPV. Basically, you have to discount the future cash inflows. Dollar inflows giving you the present value of dollar inflow, deducting the dollar outflow give you dollar NPV. Since that NPV is at 0 point, you can, using the spot rate, convert that to rupee NPV, which is ultimately the home currency NPV that I need. Now the point of learning here was, if the cash flows is rupee, the discounting rate will be different. If the cash flows are dollar, the discounting rate will be different. Examiner generally gives you the rupee discounting rate, but if I follow home currency approach, I need to find out the dollar discounting rate. And how do I find that out? Has a simple relationship. So I will say 1 plus rupee, 1 plus discount rate, which is in rupee, 1 plus discounting rate, which is in rupee, is nothing but 1 plus risk free rate of India, which is rupee risk free rate, into 1 plus risk premium. Do you people remember from the basics that the required rate of return is made up of the risk free rate and the risk premium? So 1 plus risk free rate in India, which is in rupee, plus into 1 plus risk premium, gives you the 1 plus rupee discounting rate. So if you have the discounting rate of rupee, if you have the risk free rate of rupee, can you find out the risk premium of the project? Yes. Using the same risk premium of the project, you can use the risk-free rate of US, which is dollar, and using the risk-free rate of dollar and using the risk premium of the project, you can find out the discounting rate of dollar. Requesting your responses, this discounting rate of dollar can be calculated and used here that we wanted to use in case of foreign currency approach. Could you all connect to me on this, requesting your responses? People in the class, please participate. So let me tell you all here one particular thing. Boss, the fact that if the, again, a tip to solve the practical question, if the examiner is silent, you have to assume the given discounting rate given in the question as the home currency discounting rate, right? Because an Indian company will give you in the question an Indian discounting rate. Then if you have to apply the foreign currency approach, you have to find the dollar discounting rate using the Indian discounting rate. That much, that simple, people in the class, is the concept. Now I'll tell you to the practical question where we have to solve some practical question on this topic. Cool. So let me, people, take you all to that particular thing. Come on. So first practical question that we are going to do in the class is question number 84. First practical question, everyone, is question number 84. Ready are we all? Can we all please proceed ahead? People, sorted? Yes, yes, yes. Come on. So now we'll have to see that initially some people showed up the determination. So initially some people committed that, sir, we've liked the video. If you are someone who was watching this video and not liked it yet, please, 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 you have to do it. It motivates me that whatever I'm doing is helping you out. First thing. Second, some people initially committed that, sir, we are going to be there till the end point. This is not our motivation for the time being. It is our, people, determination. It is our discipline to do it. So let's see how many of you are going to be there with me till the end. Come on, right? So, sir, question number 84 says that DD Limited is a company which is based in India, manufactures the leather. Cool, right? The cost of leather, manufactures the leather bag. The cost of quality leather in India is very high. Now listen to this line. The company is reviewing the proposal. What is the proposal they are reviewing? They are trying to evaluate. The proposal is that the proposal of importing of leather in bulk from US supplier. So rather than now buying the leather from India, we are planning to import that leather from US. So the estimate of net USD and Indian rupee cash flow in nominal terms for this proposal are given below. What was the proposal? To bulk import the leather. Related to this proposal, people in the class, related to this proposal, we have been given the cash flows that in the 0 year, in terms of dollar, there will be an outflow of 25 lakh rupees. Then in the end of year 1 to 3, there will be inflow of 567, sorry, 5, 7 and 8. In Indian rupee terms, initially there is zero outflow, but 60, 80 and 90 lakhs will be the inflow. If not imported, the cost of leather to be purchased in India, if you don't import the leather from US, then you will have to buy it in India. How much will that cost? 400, 450, 500 and 600. This question I'm marking as ambiguous because out of these 3 to 4 attempts, in one particular attempt it was asked with ambiguity, then in the other attempts the ambiguity got rectified. I'm preparing you for the ambiguous question. If that ambiguity is not there, your life is anyway sorted. Cool. Sir, DD evaluates all the investment at a discounting rate of 9%. Please tell me, this 9% discounting rate is the rupee discounting rate, home currency, or dollar discounting rate, which is foreign currency? You'll need to answer this question, the first thing. Next, all the customer are invoiced in dollar. Obviously, that is why the cash flow are in dollar. Dollar cash flows are converted into rupee at forward rate and discounted at Indian rate. This particular line, people in the class, gives you what hint is my question to you. Please participate. When you read this line, what are you getting? What are you getting to know from this line? People, I need your response. They are asking you to first convert the cash flow using forward rate and then apply the discounting rate, Indian discounting rate, which means, are you people agreeing that they are guiding you for the home currency approach to be followed in the question? Hello, where the home currency discounting rate of 9% is given, where the home currency present value factor of 9% have been given. Yes. So now I will say inflation rate in US and India are 9 and 8%. Sir, why would they give you inflation rate if the cash flows are already nominal? Let me tell you, if you are given the spot rate of rupee per dollar 74, then using these inflation rate, you can find out the spot rate of year 1 to 3, or I can say the forward rate of year 1 to 3. And once you have those forward rates, you can, people in the class, use those exchange rates to convert the US cash flow to rupee cash flow. So first thing will be to convert. Sir, 74 is the rate at 0 point. So 74 multiplied by Indian rate, which is 1.0, divided by the US rate, which is 1.09, give me the rate of 73.32 in 2 digits after the decimal point as the rate of first year. Similarly, 73.32 into 1.0 divided by 1.09 give you 72.65, and similarly third year you get 71.98. Now the focus has to be to catch the rhythm. The focus will not be number, the focus will be to catch rhythm. Sir, I have US cash flow, I have Indian cash flow. Indian cash flow is already in rupee. I need to first convert the US cash flow to Indian cash flow, add Indian cash flow to it so that I can find the total cash flow in rupee term related to that project and then find its NPV, correct? Sir, US cash flow involved 25,578, 25 negative, 578 positive. At the end of respective year, at 0 point, the rate given to is 74, and the respective year end the rates are this. Accordingly, the rupee cash flow of USD, the rupee amount of US cash flow will be 1850, 366, 508 and 575. Cool. Sir, now the ambiguity. Do you agree the cost related to importing the leather in bulk is already included in the cash flows? Yes, because the estimates which are given to us is for this proposal. Then proposal is what? Importing in bulk the leather from US. So in this cash flow, the cost of leather is already there, which means, is there a need to again deduct the cost of buying the leather in India? The answer is obviously no. You cannot consider any cost twice. So examiner ambiguously has considered this cost twice. Examiner has deducted 400, 450, 500 and 600 here. Yes. So which is why ambiguity, hopefully institute will ask you this question without this ambiguity. It will not give you this particular information to you. If it does, then you have to please remember it is also to be considered as an outflow. You might feel it is double counting of that leather cost. It is, but you have to do it as it is. Am I clear, everyone in the class? So we will everyone say cost of leather if not imported is this. Sir, Indian cash flow in rupee lakhs is outflow of 60, 80 and 90. Sorry, inflow of 60, 80 and 90. Give me the total cash flow in rupee terms to be this. If 9% is the discounting rate, present value is not a big deal then. Future cash inflows are there, you can discount it, deduct the initial outflow, you get the NPV. Since it is negative, the project is not doable. Requesting your responses, could I make you people do question number 84? What do you all say? Yes or no? Quick. People. Question number 84, could I make you people do it? Quick. Yes, no. Please, what do you all say? Accordingly, we will do some more questions of category A and I will guide you on other point of learning of other questions. Can I take you all ahead? So, sir, let's proceed to the next discussion, which is question number 82. In question number 82, which is an extremely easy question, you have to solve the question using home currency and then using foreign currency approach. In case of home currency approach, you will need the exchange rate of respective end. So if you have been given the spot rate and if you have been given the risk-free rates, can you use interest rate parity theorem? Similarly, similar to the previous question, to predict the rate applicable in the future years. So similarly, you will have the exchange rate applicable to the coming years. So, sir, home currency approach is simple. You have the respective year end cash flow in foreign currency, convert them using this rate to home currency and then calculate NPV. What is another alternative? Foreign currency approach, which will involve what? Whatever cash flow you have in foreign currency, you find the NPV of that first. And that NPV is converted to the home currency using a spot rate of 0 point because NPV is at present value is at 0 point. Hello? Hello. Christine, the exam, if that cost comes again, that you will have to deduct it, as I said. Requesting people in the class 82nd is an extremely easy question. You have to please do it at your own. Am I clear with it? Requesting your responses. Come on. Come on. If you say no, I can re-explain. If you say yes, it'll be great. What's your comfort? Accordingly, I'll be able to then take you to question number 83. Sorted are you? Comfortable are you? Yes. So great, guys. Just give me a second. Yes. Fine. You will have to please remind me, Esther, for that. Esther, you'll have to remind me for that. Okay. Sir, question number 83, right? The question is really easy to solve. The question is difficult to interpret what that is trying to say. The question is trying to say that there's this US based company. So what is the importance of which country does the company belong to? The importance is that your final answer of NPV should be in that particular currency. So if there's this US company, then you have to remember that the home currency is US dollar and your ultimate answer of NPV has to be in dollar. So it says that a US company is planning to set up a software development unit in India. Fine. Software developed in the Indian unit will be bought back by the US parent at a transfer price of 10 billion. So, sir, there is this US company, right? US company will set up a unit in India. Indian unit will develop the software and sell it to US at what price? At a price of $10 million. But as I explained it in the class, this is not the actual price. This is the transfer price calculated for the purpose of direct taxation, calculated for the purpose of calculating tax liability in India. This is actually arm's length price. Fine. The unit will remain in existence in India for 1 year. Software is expected to get developed in 1 year. Fine. US company is subject to corporate tax of 30%. Sir, the US company in India will have to pay 30% corporate tax and 10% withholding tax. But that tax will be paid on the profit. How do you calculate profit? Revenue minus cost. What is to be considered revenue? 10 million, which according to income tax is considered revenue as per arm's length price. Fine, sir. Cool. Now, the software is sold in the US market for 12 million. So, sir, the US company can sell that software in the US for 12 million. What is the cost of purchasing of software for the US company? Is it 10 million? No. US company does not pay any amount to the Indian unit because they are the same company. That 10 million is an assumption by the Indian income tax department. So overall, if you consider this entire box to be one company, US and India collectively to be one company, the inflow is 12 million. The outflow is the outflow incurred to develop this software, like outflow of rent, outflow of manpower, outflow of administrative cost. These are the costs incurred, and the tax paid in India, 30% corporate and 10% withholding tax. Using the inflow of 12 million and using the outflow by this Indian entity, you have to please figure out, is this project worth doing or not? Do you please understand what this question is trying to explain? Requesting your response. Observation number one, do you have multiple years in this question? No, the entire question is at only a single point. All the cash flows are at a single point, which is first year end, which is why you don't need discounting rate. Second, do you need to convert dollar inflow to rupee? Or do you need to convert rupee outflow to dollar and calculate NPV in dollar? Sir, I have to advise US company. My final answer, everyone in the class, has to be in dollar, and the rupee per dollar rate is 48. So let's first list out the expenses. What I'll say, sir, my notional revenue, not actual, is 10 million into 48 is 48 crores, from which I pay rent, I pay manpower cost, I pay admin cost. So once the expenses have been met, the PBT is this. Is this actual PBT? No, only for the purpose of tax, it is my PBT. Sir, corporate tax rate is 30%, and after when I get PAT, the withholding tax rate is this. So if I want to find out the total amount of cash cost, can I say these are the five costs which I incurred? Rent, admin, manpower, corporate tax, withholding tax. You can add up five expenses, or you can apply common sense that if my notional revenue is this, from which if I deduct my notional profit, so revenue minus profit automatically gives me cost. So adding up all five number also give me the same number, which is 25 crore 28 lakhs 85,000. So if you have this initial outflow, sorry, if you have the outflow to manufacture or to develop the software, let's convert it into the dollar. If rupee per dollar rate is 48, so 25 crore 28 lakhs divided by 48 give me 5.268 million. 5.268 million. So inflow is 12 million, outflow is 5.268 million. Sir, which is the inflow? 12 million. The US company people in the class received. The software will be sold in the US for 12 million. So inflow received by the US company is 12 million. Then Indian company made an outflow into five different expenses as 5.268 million. The difference is 6.731 million, which is positive. Hence, the project is viable. Could I please explain question number 83 to you? Please tell me. Requesting everyone in the class your responses. Could I successfully explain question number 83? What do you all say? Hello? 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 Please, everyone. Question 87 is another A category question. We are not solving it in the class, but question 87 belongs to the concept of swap, right? Right. We are not entering into this concept right now. Asked once in the exam in the attempt of November 24. This question is from the study material, right? You must consider to do this A category question, right? Those who are sitting watching up this video and do not know, let me tell you, I have given a list of around 180 questions which are considered A category questions, which if you do will cover a lot of variety of concepts, right? Next question that we have to solve in the class is this particular question, question number 91. For this question, the mindset that you all need to have, the mindset people in the class need to have is the incremental mindset, is the replacement mindset, right? In advanced capital budgeting, we do study this replacement decision, all right? Very clearly or in a very short manner, let me explain that to you. One is people in the class. Suppose I've been using an existing machine. What are the two choices? One choice is to continue to use that machine. Think practically. When I stand at a point, imagine that I've been using this phone. Choice number one is continue to use this phone for the next 5 years. Choice number two, sell this phone, go to the market, sell this phone, buy a new phone, and then continue to use the new phone for the next 5 years. These are the two practical choices available, right? Option one, continue to use the old phone. In that case, will there be some initial outflow? You will have to figure out. Will there be annual inflows? You will have to figure out. And will there be terminal inflow? You have to figure out. If I go to option two, which involves selling of old phone, buying the new phone, and then continue to use it, sir, will that initial selling and buying will require some net inflow outflow? Yes. Will that annual inflow be there something? Yes. And will there be a terminal inflow? Yes. Once you evaluate both of these alternatives completely independently, when you think about alternative one, don't pay attention to alternative two. When you think about alternative two, you don't have to think about alternative one. Once you have identified the initial inflow outflow, the annual inflows, and the terminal inflow for both the alternatives, at the end you have to think incremental as compared to alternative one. In the alternative two, how much is extra initial outflow? As compared to alternative one, in the alternative two, how much is extra or incremental annual inflows? And similarly for the terminal inflow. Once you have the incremental initial outflow, when you have the incremental annual inflow, once you have the incremental terminal inflow, right, you can calculate the NPV of those incremental cash flows, calling it to be the incremental NPV. I tried to explain a concept in a very short manner. Could I successfully do it? Please, please, please. Live people, recorded people, you all need to please tell me, could I successfully do it? Only in your imagination could I explain what I was trying to? People. Based on that is question number 91, and based on that is the concept of replacement decision in advanced capital budgeting. If I tell you that concept of advanced capital budgeting in the that concept of replacement decision in the advanced capital budgeting is this, is how the way I explained is how exactly you have to solve the questions out there. So focusing on question number 91, let's say there's this MNC planning to set up a subsidiary in India where it was exporting. So option one become continue to export. Option two, close the export business and set up that subsidiary in India. The view of growing demand of its product. The initial project cost will consist of 500 million for plant machine. Working capital will be 50 million. Company follow SLM method. Companies at present exporting 2 million units. Sir, it was so far has been exporting. Option one is continue to export. So how much it has been exporting so far? It has been exporting 2 million unit where the selling price is 80 and the variable cost is 40. Cool. The CFO has estimated with respect to the proposed project. What is the proposed project? Set up the factory in India. With respect to setting up, what is the information given? The information given is variable operating cost will be 20. So far I have been incurring 40, but if I set up a factory in India, the cost will be 20. The additional fixed cost as compared to option one, in the option two, the incremental directly fixed cost is given. The incremental fixed cost will be 30 million per annum, and then there are some allocated fixed cost. You have to know the basics. The allocated fixed cost is never considered in capital budgeting. Cool. They are irrelevant. Sir, production capacity in the new case will be 5 million. So far it was 2 million, but if I go to alternative 2, the production capacity will be 5 million. The useful life, people in the class, of the project will be 5 year. The new project has 5 year of life without salvage value. So amount of depreciation will be how much? 500 million initial investment divided by 5 year of life without salvage value. 5 year of life here will give me 100 million as the amount of depreciation per year. Existing working capital with the production of sale of 2 million units is 15 million. Sir, at this point where I'm continuing to export, if I continue to export 15 million, how much is the working capital already invested? Sir, 15 million. For those 2 million units which I'm exporting, the working capital already invested is 15 million. What is its implication? If you do alternative 2, what is alternative 2? Close business 1, close the existing business and start the new business. Alternative 2 is not only start the new business, it is close the old business, start the new business. Close the old machine, buy the new machine. So if I close the old business, do you agree in case of alternative 2, when I close the old business, 15 million of working capital gets immediately realized, although there is new investment of 550 million. Fine, sir. Cool. Sir, export in the coming year will decrease to 1.5. If I continue to go to alternative 1, if I continue to export, the units sold will fall from 2 million to 1.5 million. Sir, tax rate 35%, required rate of 12%, calculate NPV. Let's first think about initial outflow. When I continue to do older business, I continue to export, is there additional sorry, is there a new initial investment required? No, sir. 15 million of working capital is already invested. Nothing new is required. So how much is the outflow here? No outflow here. Now I'm going to alternative 2. Sir, pay attention. To alternative 2, your doubt will be resolved. Alternative 2 people in the class involves sale of old machine, buy of new machine. Closure of old business, start of new business. So when I close the old business, the working capital of 15 million get realized. When I close the export business and set up a factory in India, right? I initially I was exporting it to India. So when I close that export business, 15 million of working capital will realize. But when I set up a new factory in India, 550 gets invested. So 500 plus 50 minus 15 give me 535 as the initial outflow in alternative 2. Alternative 1 initial outflow is 0. Alternative 2 initial outflow is 535. So how much is the incremental outflow people in the class in alternative 2? 535 only. Is the first thing requesting people in the class your responses please clear. Now, sir, annual inflow. Alternative 1 involved cost of 80, sorry, revenue of 80, cost of 40. So how much is the contribution? 40. Number of unit that will be now sold in future is 1.5. So 40 into 1.5 give me 60. So how much is the contribution per, how much is the total contribution? 40 rupees per unit. Multiplied by 1.5 million unit give me 60 million unit is the total country. Sir, is the fixed cost in the existing business given? No. Is there any depreciation given? No. So can I say this contribution directly become my EBT, on which if you pay 35% tax, the PAT or CFAT become 39. To the PAT, when you add back depreciation, you get CFAT, but now when there is no depreciation, it become my CFAT 39. So if I continue to follow the old business, continue to do the old business, CFAT that I realize is 39. However, if you do new business, what will happen? Sir, you will have revenue of 80 on 5 million units. So 80 into 5 become 400 million of revenue. You will have the cost of 20 on 5 million unit, give me 100, right? Minus additional fixed cost of 30, depreciation of 100. Sir, 500 is the total investment. Working capital, there is no depreciation. The depreciation is there only on the fixed capital of 500 divided by 5, give me 100 of depreciation. Give me PBT, give me PBT of how much? 170 minus tax of 35 give me PAT, to which if I add back depreciation, I get CFAT. So when I do business, when I do alternative 1, 39 is CFAT. When I do alternative 2, 210.5 becomes CFAT. How much is the incremental CFAT? That people in the class is incremental of 171.5, which is 210 minus 39 is 171.5. Cool. What about the terminal cash flow? If I continue to do old business, ultimately what gets realized is the working capital which is blocked in the original business of 15 million. If I close the old business, start the new and continue new, and ultimately after 5 years close the new business, I will realize a working capital of 50. Initially, what you invest in terms of working capital is automatically assumed to be realized at the end. Hello? Are you all people connected to me on this or not requesting your responses? So I will say the terminal value here is 15. Terminal cash inflow is 15. The terminal cash inflow here is 50. So how much is the incremental terminal inflow of alternative 2 is 35. So overall conclusion, people in the class, can I say, as compared to alternative 1, alternative 2 require initially 535 extra, but it will generate 171 extra for 5 year and it will generate 35 extra at the end in 5th year. So extra outflow and extra inflow, if you have, can you find out the extra NPV, calling it to be incremental NPV? Really simple: initial outflow, annual inflow, terminal inflow. Present value factor, present value annuity factor, present value factor give me the final NPV, which I can calculate like this. My focus was not to do NPV, which is extremely easy. My focus was to make you people understand to calculate the incremental cash inflows and outflows. Could I, requesting your responses, please successfully do it in this particular question? Tell me. Question number 91, how is your comfort? People, please tell me. Question number 91, how is your comfort? Requesting your responses, people. Please, 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 please. 93, oh, okay, 93 is not this question. 93 is advanced adjusted present value question, which is what we are not covering here. So other than that, all the A category questions have been done, right? B category questions, your choice. If the time allows, you all should do it. So live people sitting here, please respond to me. Are you all there? Could I explain this particular question? And that is how everyone in the class, let me tell you, your discussion on the questions of international capital budgeting gets done. Sorted, are we? Asked 9 times in the past 17 attempts was this particular topic. And now I'll take you to the next concept, and that is when the IFM International Financial Management chapter will get done, which is the concept of ADR, GDR. So easy, right? This concept require doing only one particular question. So let's go to that question. I will explain that question out there. The concept I'll explain directly in that question. So reminder to timestamping people, please timeline on your timestamp, please mark this topic of ADR, GDR, right? I'll take you to this particular topic here. Asked multiple times by the institute, please observe, asked multiple times by the institute, the same repetitive question is what you have to do. Perfect. Cool. What it says, there's this company called as Raghu Limited who's interested in expanding an operation, planning to install a plant in US. Cool. It require 8.82 million USD. As a Raghu, when I want to do a factory setup, I will require 8.82 million USD of fund, right? GDR are proposed to be issued. Where would Raghu get this amount from by issuing GDR? So GDR is like Raghu is an Indian company. Indian company will go to US and issue the depository receipt. Now, for a moment, let me take you all to the concept so that you realize what's going on. What happens is that, suppose there is this company called as Raghu Limited. Raghu Limited will go to US. There is this authority in the US called as depository. So Raghu Limited will issue its share to the US authority, and the US authority will issue its depository receipts to the investor out there in the US. One thing, this depository receipt represents the share of Raghu Limited. So if the price of the share of Raghu Limited increases, the price of depository receipt also increases. First. Second, share are in rupee, but the repository receipt will be in the currency of that particular country, which is in dollar. Third, one depository receipt can have multiple shares of the particular company, Raghu Limited. Based on this information, we have to find out when a share is issued to the investor out there in US, what will the issue price be? So let's get back to the practical question, and you'll realize how simple is that. It says that GDR is proposed to be issued where the flotation cost is 2%. Expected market price of share at the time of issue of GDR is 360. Fine, sir. Every share that is being that's traded in the market is 360. So the issue price of GDR out there in US will be based on the market price here. Cool. Each GDR will comprise of 2 shares. So 360 is the price of 1 share. Each GDR has 2 shares. So the rupee value of GDR becomes 720. We are planning to issue at 10% discount. So minus 10% discount give me 648 as the issue price in rupee terms. But GDR are issued in dollar and rupee per dollar rate is 72. So divided by 72 give me $9 as the issue price. How many of y'all are able to connect such a basic thing? That $9 people in the class is the issue price. Till this point, how much out of 10 are you people sorted? Please respond to me. Accordingly, I'll be able to take you ahead. Come on. Come on, come on, come on. Super ultra fast. Can I say? 9%, $9 become my issue price. Sir, but every unit that I issue, I don't get 9. I get minus 2%. So 9 minus 2% because there's a flotation cost of 2% give me $8.82 as the amount that I receive as the net proceed. There is a difference. Issue price is the price at which I issue. But after the flotation cost, what I get is called as net proceed, which is $8.82 per GDR. The total amount I require is 8.82 million. The total amount I require is 8.82 million. Every GDR that I issue, I get an issue price of only $8.82. How many GDRs are needed to be issued? People in the class, that is 1 million GDR. Are you understanding how simple this particular question is? That extreme simple this particular question is. And now I'll tell you, sir, they are asking how much is the cost of GDR. So you remember that formula D1 divided by P0 plus G, the Gordon's formula. Similarly, you have D1 divided by net proceed per G plus G. Sir, they are saying dividend is expected to be paid at the rate of 20%, which will grow at the rate of 12%. Expected to be paid as D1. Sir, 20% of face value. So 20 rupee being the amount of dividend per share. There are 2 shares in every GDR. So 40 rupees become the amount of dividend. But amount of dividend dollars will be how much? In dollar divided by 40 will be 40 divided by 72. So 40 divided by 72 become the amount of dividend as 0.5556 as your D1 in dollar. So D1 in dollar is this divided by the net proceed in dollar. People in the class is 8.82. How much is the amount you receive in dollar? Net 8.82. How much is the growth rate? 12%. So D1 divided by net proceed plus growth rate give you 18.3 as the cost of GDR, similar to how you have the cost of equity. Can I also explain this particular part here again, which is again very easy. Super fast, people. You have to please validate to me again. Accordingly, I'll be able to take you ahead. So you have learned one more thing. First you learned, sir, at every GDR that will be issued to these people, what will be the issue price? Then you learned what will be net proceed. Then you learned how much will be the number of GDR being issued. And last you learned cost of GDR. These are written here, the explanation, but I don't want you to remember the formula at all. These are not official formula. All you have to do is to focus on the understanding, which is what we have done in this question out here. Next, they say there is the bank who is giving you ready to loan at 12%. If you issue your GDR to raise money, cost is 18.3. The bank is ready to give you loan at the rate of 12%. We will theoretically say accept the offer because it is cheaper. And how much will be the savings? Sir, 18 minus 12.3 give you 6.3% per annum is the amount being saved. That is question number 94, the concept of ADR, GDR repeatedly asked. Right? So this brings us to the completion of these two particular concepts and the entire chapter of mutual fund and IFM so far in this video. Boss. Entire chapter, two topics were primarily needed to be covered. Are you people settled? Now I'll take you all. People, what I'll take you all with? Now I'll take you all to the next chapter, the chapter of M&A, which requires repeatedly asked two things to be done: calculating post-merger EPS, and based on that, similarly, the post-merger MPS. Are you all ready for that? If you are comfortable, we will continue. If you need a break of maximum 5 minutes, we can take it right now. But otherwise, a long break, we will take it later when needed. At this point, we can afford to take a short break. People in the class, a status please. Are you all there? Ready to take a short break with me? I don't need it. If you are comfortable, we will continue. Just respond to me. What is your status? Continue or break? What do you want? Super fast, people. Respond to me. What do you want? You feel like taking 5 minutes of break, which is absolutely fine. It is 9:08 right now. Let's meet back. Let's meet back at 9. Uh, it is 9:10 right now. Let's meet back at 9:15. Then do the topics of M&A, IRRM, whatever, as we get it in the flow. Cool. Please be back after 5 minutes and then we proceed ahead with the rest of the topics. All right, people. Bye bye. I'll see you all after the break. Okay. Please go for a break. Please. Come on, are you people all there from the back, from the break? Are you people back from the break? Tell me, please. Everyone in the class settled? Yes. So that 5 minute break must have felt like 2 minutes, right? Which is good, which is good. We are not very exhausted. We have just started the things. You have just done 5 concepts so far. Right. The only thing is the five concepts that we did, the variety of questions that we did on these concepts were so diverse that it took time, which is great, right? Which is okay because these questions are very frequently asked. Fine. Sir, now we will tell you, I will take you to the chapter of M&A, where the calculation of post-merger EPS has been asked 4 times. And post-merger EPS and then in continuation to that post-merger MPS is asked 8 times, right? Let me give you a clarification here. The class students will be able to connect and others in the class you have to realize that when you calculate, so let me once again, let me take you to the out notes, the concepts notes. The chapter of M&A which is here. Great. So guys, please pay attention. You may be needed to calculate in the exam post-merger EPS, yes sir, or you may be needed to calculate post-merger MPS. Post-merger MPS can be calculated in the CA final AFM curriculum in 2 ways. Which 2 ways? First, you have to do my value, which means market value of acquirer plus the market value of target plus the synergy in value to give you the post-merger market value. That is one possibility. Another possibility is calculating the post-merger market value using PAT multiplied by PE. So the post-merger PAT into post-merger PE give me the post-merger market value using which MPS can be calculated. 2 ways: market value plus synergy in value. Another of this PAT into PE. So if examiner, if I have my PAT plus your PAT into synergy in PAT give me the post-merger PAT, into post-merger PE will give me post-merger market value. The examiner has repeatedly asked which particular situation. The PAT into PE situation has been asked repeatedly. Value plus value situation is not asked repeatedly. Could I make you people first of all understand what is the frequently tested topic? When I tell you post merger MPS through earnings, so finding the MPS or market value not through value but through earnings. Could you all connect to it? People in the class requesting the responses. So let's first focus on the post merger EPS. That too primarily institute ask you stock deal. However, we can also think of cash deal, which is doable, which is very easy. So let's proceed ahead with the stock deal. Sir, let's first do the concept. Examiner give you the data, the pre-merger part of the companies have been given, right? Please understand you don't have to focus on the numbers, you have to focus on the flow. So let me directly explain the flow. Can I say post-merger EPS of acquirer? Say target company will not be there after merger. Only the acquirer will be there. So if I want to find out EPS, can I say it is PAT divided by number of share? Yes. So if you have to find the post-merger EPS, you have to take post-merger PAT divided by post-merger number of share. What is post-merger PAT? My PAT, which is acquirer, your PAT, which is target, plus synergy in earnings, synergy in PAT, if any, divided by my number of shares plus against your number of share, right? If I give you an exchange ratio, so n, which is the number of share of target multiplied by exchange ratio, gives you the number of share issued to you. That will give me the total post merger number of share, and that is how you find the post merger EPS. Suppose with this approach, if I find the post merger EPS, it turn out to be rupee 12. For the acquirer, it turn out to be rupee 12. So I will say, first I'll have to find the equivalent or adjusted EPS. Why? Because for acquirer, I can say the EPS which was 8.5 now has become 12. But for target, can I say the EPS which was rupees 8? Sorry, I'll say that again. EPS which was 8 has now become 12. For the acquirer, I can say so. But for the target, can I say the EPS which was 4 has become 12? No. 4 was your EPS on one old share. And against that one old share in the new company, you get only 6 rupee of EPS, calling it to be the equivalent EPS. So your 4 rupee of EPS can be compared with 6. So now I'll say my 8 has become 12, so I have gained 4 rupee in terms of EPS. Your 4 has become 6, so you have gained 2 rupee in terms of EPS multiplied by pre-merger number of share, and 30 and 20,000 give me the total gain or loss in terms of EPS. Is the very first thing which is calculating the post-merger EPS and the gain loss on it clear? If the answer is yes, I will take you to the practical question, right? Timestamping people, if you can go back for me a few seconds and timestamp that concept, please do it. I'll take you guys to the questions of M&A. Super ultra fast, the first question that I'll do for you is this particular question. Let's say question number 1 only, super fast. Boss, XYZ is considering merger with ABC. XY share are currently trading at rupee 20. So one company is trying to merge with another. Who's acquirer, who's target? The information is not clear. XYZ, one company share is 20. The number of share is 2,50,000. Total earnings PAT is 5 lakh. Sir, ABC, another company, 1,25,000 share. Market price per share 10. Earnings after taxes 1,25,000. Merger will be affected by mean of stock swap, which means it is a stock deal. Second, ABC has agreed to a plan under which XYZ will offer the current market price to ABC Limited share. Sir, using this line, can you please tell me who's acquirer, who's target? If I am XYZ, I'm offering to you price. Do you people agree? If I am offering to you price, which means I am trying to buy you, which means you are the company being sold, you are a target company, which is why I'm offering a price to you. So XYZ being the acquirer company and ABC people in the class become a target company. That is what this line tries to explain. Cool, sir. If pre-merger earnings, so what is the pre-merger earning and P ratio of the both the companies, sir? 2,50,000 share, right? And 5 lakh is PAT. So 5 divided by 250 give me 2 rupee of EPS. Sir, 125 divided by 125. Sorry, PAT of 125 divided by number of share of 125 give me 1 rupee of EPS. If market price in the if the share price in the market is 20 and 10, so 20 divided by 2 rupee of EPS give me 10 times P, and 10 rupee of market price divided by 1 rupee of EPS give me 10 times of P. So first part of the question very easy, gets done. Second, what is ABC's P ratio? What is, if ABC P ratio is 6.4, what is the market price for this company? If P ratio is 6.4, what become the market price? Can I say EPS into P is MPS? So EPS is 1. If P changes to 6.4, the market price people in the class will also change to 6.4. And in that case, what is the exchange ratio? Can I say we are trying to offer to another company a price equal to its market price? So what is the formula of exchange ratio? EPS of target divided by EPS of acquirer. Target EPS. Sorry. My bad. Fir se. I'll say it again. MPS of target divided by MPS of acquirer. What is the MPS of target? 6.4. What is the MPS of acquirer? Sir, 20. So 6.4 divided by 20 give me 0.32 as the exchange ratio. You can do it. MPS divided by MPS. 6.4 divided by 20 give me 0.32 is to 1 as the exchange ratio to be given to the other party. Sir, what is XYZ post-merger EPS? So my PAT plus your PAT plus synergy in PAT divided by my shares plus the share issued to you. My PAT 5 lakh, your PAT 125. So 5 lakh plus 125 is the numerator divided by I have share of 2,50,000 plus against your 1,25,000 share, I'll give you an exchange ratio of 0.32. So it becomes 6,25,000 divided by 1,25,000 into 0.32 plus 2,50,000. Sorry, 1,25,000 into 0.32, which is 40,000 plus 2,50,000 gives M plus, which is 290. And 6,25,000 divided by memory recollect give me 2.16, which is 1.5155 is the post-merger EPS. Are you able to connect to the solution, people in the class? Very easy. Is this the exam question? Yes. Sir, show the impact on the earnings. So I will say post-merger EPS, this equivalent EPS will be how much into 0.3 to give me 0.6912 something on a rounded off basis. So post minus pre. 2.16 is the post of acquirer minus pre was 2. 0.6912 is the post of equivalent of target minus pre of 1. Give you the gain loss on a per share basis multiplied by pre-merger number of share, give you the total gain loss in terms of earning. Numbers are not played, but flow or the feel of the solution we have done. Requesting your responses. Question number 1, how much out of 10 are you people? Please set. Basically, the point is not to, we are not bound to cover something within a particular time frame. We are bound to cover it such that you have a comfort over what we've done. Is that comfort there in this particular question? Requesting your responses, please tell me. Come on. Live people sitting here, is that comfort there? Now I'll take you to the next concept related to it and to the next question. Timeline people, timestamping people, now you don't have to timestamp it. Sir, please understand something called as break-even exchange ratio. So examiner, sometimes it might happen. See, previously it gave you the break-even exchange ratio and ask you to calculate the post-merger EPS and ask you to calculate the gain loss in terms of EPS. Now examiner asks you the break-even exchange ratio. What are the ways it can ask you are these? It can ask you, tell us the exchange ratio such that EPS is maintained, such that the pre same as post, such that there is no gain loss, because break even means no gain loss. So I will say EPS of target divided by EPS of acquirer is the break even exchange ratio. Sufficient. And for that ratio, you will have to justify that, see, there is no gain loss. You have to calculate using that suggested break even ratio. You'll have to calculate post merger EPS and prove that there is no gain loss. Let's proceed to solve a practical question and you'll be able to automatically connect to what I'm trying to say. Let's solve this particular question, question number 5. Come on, come on. Question number 5, super fast. Sir, M company is trying to acquire N company. So please observe, I've played with it. M company is the acquirer is this column and N company is the target is this column. So Pat has given number of share given, market price per share given. What is the present EPS of both the companies? 80 divided by 16 is 5 rupee. 24 divided by 4 is 6 rupees. So present EPS is 5 and 6. Cool. Sir, if the merger goes through exchange of equity, which means if it is a stock deal, what is the new EPS? But what is the exchange ratio? Sir, in the absence of information, exchange ratio is based on market price. So what is target? 160. What is acquired? 200. What is the exchange ratio? 160 divided by 200. The exchange ratio becomes 0.8 is to 1, which is MPS of target divided by MPS of acquirer. Fine. Next, what is the new EPS, right? So my pat 80 plus your pat 24 divided by my share 16 plus against your share of 4 lakhs, we will give you exchange ratio of 0.8. So 80 plus 24 divided by 16 plus 4 into 0.8 give me the post-merger EPS to be 5.4167. Was that easy? Extremely, sir. Next is what the exchange ratio should be if N Limited wants to be sure that earnings should not be diminished by the merger. What should be the exchange ratio? Earnings are same as before. What should be the exchange ratio? If pre-merger and post-merger are to be same, what is the exchange ratio? All three questions mean the same. Tell us the break-even exchange ratio. I will say the exchange ratio based on EPS. Target's EPS is 5, target EPS is 6, acquirer is 5. The exchange ratio, people in the class, should be 6 by 5, which means 1.2 is to 1 should be the exchange ratio. So only suggesting the exchange ratio will not get you marks. You will have to justify at this revised exchange ratio what is the post-merger EPS. So I will say my part of 80 lakhs plus your part of 24 lakhs divided by my share of 16 plus against your 4 lakh share, I'll give you an exchange ratio of 1.2. When you calculate the post-merger EPS, you get 5 and equivalent EPS as 6. So I will say post is 5 and pre was also 5. No gain loss, break even. Post equivalent is 5 into 1.2, which is 6, and pre-merger of target is also 6, which means again there is no gain loss, hence it is justified. People, could I explain this? Requesting your responses, please, yes or no. Come on. Question number 5, could I explain, yes or no? There is one more question which is an A category, which is a simple question which asks you to calculate the PAT of target company in the same formula. If post-merger EPS is given here, can I say if EPS is given and one of these things are missing, then you can reverse calculate them? Yes, no, quick. And that is what this next question is about, which asks you to calculate the PAT of the target company if the post-merger EPS is given. Extremely easy question. We are not going to do it in the class, but that was just only to give you a sense. Asked in May 23 and in May 25. Question number 6. As you see here, right? Right. It involves calculating the pre-merger EPS of the target company, right? So once you have the pre-merger PAT of the target company, reverse calculate it using post-merger. See, EPS of the merged entity is 5.5. Post-merger EPS is given, pre-merger PAT is to be calculated, right? That is a question you will have to deal with at your own. And now I'll take you to the next section, which deals with question number 9, right? The concept of maximum and minimum EPS. Sir, always remember these basics. Higher is the exchange ratio, acquire is at loss. Lower is the exchange ratio, target is at loss. So as an acquirer, I will decide the maximum limit. As a target, you will decide the minimum limit. And the thought process is really simple. As an acquirer, I will say I can keep an exchange ratio, the maximum exchange ratio, such that the post-merger EPS is at least equal to pre-merger EPS. What is post-merger EPS? My PAT, your PAT, synergy impact, divided by my shares plus the shares issued to you. So what should this exchange ratio be such that the post-merger EPS so calculate should be at least equal to pre-merger EPS? That's what the thought is. Do you understand the thought? Let me now take you to the execution of it in the practical question. Then is when you will have to tell me, could you connect to me or not, right? So I'm immediately taking you all to the practical question, question number 16. A CEO of the company thinks that EPS is to be maximized. He consider maximization of EPS as company's objective. Current net income is 80 lakhs. P is 10.5. He want to buy another firm whose current income is 15.7.5 lakh. PV is 10. Please understand, in this question of EPS and in the question of MPS, which are based on EPS, you must have the five things ready with you. PAT of the company divided by number of share give you EPS of the company, multiplied by P ratio give you MPS of the company. These five basic information you will need in almost all the questions. In this question, we have been given the PAT of the company. If the P ratio, if I divide it, I get the sorry. So okay, let's proceed it. What is the maximum exchange ratio? What is the maximum exchange ratio CEO should offer so that he can keep the EPS at current level? Meaning to say, keeping in mind EPS, what should the exchange ratio be? Sir, CEO who's an acquirer, he's planning to buy another firm. So as an acquirer, he wants to decide a maximum, right? We have been given the market price of the company is 42 and 105. Is it okay, people, if I don't show you the calculation of EPS and number of share? If I have the market price and if I have the P ratio, can I not calculate EPS? Yes, sir. If you have the PAT and the EPS, can I not calculate the number of share? I can. So let's assume that this thing is ready with me. Now let's focus on the maximum exchange ratio. So as an acquirer, I will say, I'm ready to give you such an exchange ratio that my post-merger PAT is at least, post-merger EPS is at least equal to pre-merger EPS. Sir, pre-merger EPS is 4. So I would want my post-merger EPS to be 4. How do you calculate post-merger EPS? Sir, my PAT 80 lakhs plus your PAT 15 lakh 75,000 divided by my number of share 2 lakhs against your 1 lakh 50,000 share. I'm ready to give you such an exchange ratio that the post merger EPS so calculated should be at least equal to pre merger EPS of 4. Solution in such questions is very secondary. To be able to frame this equation is primary. Anyone can now solve it once you have the equation ready, because in this entire equation only exchange ratio is missing. You can calculate it whatever be the number. My question to you all is, could I explain to you the flow of this? Requesting people in the class your responses, please. Could I explain to you people the flow of it? What do you all say? Hello? Flow of it, could it be explained? Cool. Sir, now this question also has a context of cash deal. I'm not entirely explaining you the cash deal, but just giving you a sense of it, so that when you understood it to this extent, you don't have to miss something very small, very easy. Sir, cash deal says when I acquire you, I will have to pay you cash. Where will I get this cash? Let's assume I will borrow it from somewhere. When I borrow it, will I be needed to pay an interest on it, which was earlier not there? Before merger, before acquisition, was there interest? No, because there were no borrowing. But after cash deal, when I have borrowed that amount and paid that to you as a PC, I have an additional cost, which is an interest cost to be incurred in future after acquisition. So I will say my part plus your part plus synergy part is there. Minus there is an interest I will have to pay. How much of an interest? Common sense. Against your number of share, I'll give you some purchase consideration per share. So whatever cash I pay to you per share, give you the total purchase consideration to be paid to you. It is a cash deal. I don't give you a share. I will give you cash. So this gives me the total purchase consideration, the amount that I will borrow, multiplied by the rate at which I will borrow with the effect of tax 1 minus t become the net effect of interest cost on my post-merger PAT. Divided by only my share, because now you are no more the shareholder of my company given the post-merger PAT. Now, first you have learned to calculate post-merger PAT. Similarly, if someone asks you to calculate the maximum cash per share, the thought process will remain the same. We are ready to give you, see, the logic is the CEO will say post merger EPS should be at least equal to pre. Common sense. So CEO will say we are ready to give you such a cash per share that X we will find out such that the post merger PAT so calculated should be at least equal to, sorry, post merger EPS so calculate will be at least equal to pre merger EPS. So what is the situation? In this question, if you realize, he says if the CEO borrows the fund at the rate of 50%, tax rate is 30, he buys out the company by paying the cash, how much should the cash be? So I will say post-merger EPS should be same as pre. I will say my part of 80 plus your part of 18, 1575, right? Minus on your 1,50,000 share, on your 1,50,000 share, if I pay you a particular cash, that become the amount of borrowing at the rate of 15%. When the effect of 1 minus t give me the overall net interest cost effect on my PAT. So my PAT plus your PAT minus this interest cost divided by only my number of share of 20 lakhs give me post merger EPS, which should at least be equal to the pre merger EPS of 4. Everyone in the class, as I say, the calculation is secondary, but to be able to frame this equation from the concepts that you know from your thought process is primary. Could we do it? People in the class, please respond, could we do it? So finding that maximum cash per share is easy, but to be able to make this equation is the validation of thought process you will have to do right now in the class. All the live people, could I successfully do it for you? Requesting your responses. So once you have these 5 things ready for you, then the equation creation become easy. If all of you say yes, then I am happy. I can happily proceed ahead to the next thing. Clear, sir? Boss? Settled, satisfied. So this completes your entire discussion, and beyond that, in fact, to the first topic which we needed to do, which is post-merger EPS, right? Which is here. Now I'll take you to the concept of post-merger MPS. In that, the MPS based on earnings, not on value. Taking you all immediately to the next discussion. Learning to calculate post-merger MPS, but when the examiner is not, when do you follow the earnings path? When do you follow pattern to P path? When the examiner is silent regarding. When the examiner is silent regarding synergy in value. So if it does not give you synergy in value, can you do my value plus your value plus synergy in value? No. If it does not give you the post-merger market value directly, if it does not give you the ways to calculate these things, then you have to follow the earnings path, which is my PAT plus your PAT plus synergy in PAT is post-merger PAT multiplied by post-merger P is post-merger market value. So let's proceed ahead to first of all learn in the stock deal, how do you calculate post-merger MPS? Right? Hi sir, like bada diya. Who's this? What's your name? I can not see your ID. Your ID is Nature Touch. What's your ID? I can identify you the way you are saying. Pankaj? But why would you change your name? Anyways. Pankaj, all the very best for your exam. Cool. People in the class. People in the class. All right. Study well. Bye bye. Cool. Guys, I need to find out MPS. Can I say the common sense is market value divided by number of shares MPS? Yes. Sir, how do you find market value is now pattern to P. Post-merger pattern to post-merger P is the post-merger market value divided by post-merger number of shares. What is post-merger PAT? My PAT plus your PAT plus synergy in earnings, synergy PAT multiplied by post-merger P divided by my shares plus against your number of share, I'll issue an exchange ratio. Accordingly, I'll get the number of shares to be issued to you. Fine, sir. Logical, fine, sir. Now my point is here. People, can I say PAT plus synergy in earning divided by my shares plus the share issued to you automatically give me the formula of post-merger EPS? Or in other words, can I say post-merger PAT divided by post-merger number of shares is the post-merger EPS? So effectively, can I say this post-merger EPS into post-merger PE ratio can also directly give me post-merger MPS? Quick yes or no? Post-merger post-merger EPS into post-merger PE can directly give me post-merger MPS. That is the first thing you have to do. Once you calculate the post-merger, one second. Yeah. Once you calculate the post-merger MPS, similarly multiplying the exchange ratio will give you the equivalent MPS. Post-merger MPS into the exchange ratio give you equivalent MPS. And then you have to make a simple table again. Sir, post-merger MPS is there. Equivalent MPS is there. For acquirer, it is post-merger. For target, it is equivalent. Deducting the pre-merger MPS of respective company give you the increase in the market price or gain or loss to the shareholder in terms of market price. Multiplying with the number of share give you the overall gain loss to the shareholder, the total gain loss to the shareholder. Number was not important, flow was important. I will take you to the practical question as it is. Come on, come on. We have to solve question number 10, right? Asked multiple times in the exam and asked in a similar question have been asked multiple times in the exam, right? Starting with this question, starting to read this question. Come on, people. A Limited, everyone in the class wants to acquire T Limited and was offered a swap ratio of 1:2. So the company A Limited acquired T, so acquirer is their target is their swap ratio is 0.5, which means it is a stock deal. Fine, sir. Pat of the company given, number of share given, give me EPS multiplied P ratio, give me the price quoting on the share market, 30 and 14 given. So those five basic informations have been given. Now you have to, everyone in the class, pay attention to it. You are required to determine the number of equity share to be determined by A Limited for the acquisition of T. If I don't teach you, can you all please answer this question for me? Interpret this question at your own, answer it for me. Come on, super fast, everyone. Please, please, please. If I don't interpret it for you, what do you all say? Number of share to be issued, such a common sense. Sir, your number of share is 1,80,000. If the exchange ratio is 0.5, I will have to issue to you 90,000 shares. Such a common sense. The answer is yes. Sorted. Next, what is the EPS after acquisition? So my pat 18 lakhs, your pat 360 divided by my share of 6 lakh plus the share issued to you, which is 180 into 0.5, or you can say 90,000. So 18 plus 360 divided by 6 plus 90 give me the post-merger EPS to be 3.13. Sir, that's extremely easy. Determine the equivalent EPS. So 3.13 into the exchange ratio of 0.5 give me 1.565 as the equivalent EPS. That's also easy, sir. Fine. What is the next thing? Sir, what is expected MPS of A Limited after the acquisition, assuming the P ratio remain unchanged? Post-merger MPS is what they are asking. Once we have post-merger EPS, you can directly multiply post-merger P ratio to find the post-merger MPS. But sir, post-merger P is specifically not given, but they are saying it remain unchanged. Even if the question is silent, you can make this assumption of P ratio remaining unchanged. If PE was previously 10 times, then I can continue to assume it 10. So post-merger EPS multiplied by PE of 10 give me post-merger MPS of 31.3. So 3.13 into 10 give me 31.3. Sorted. Next, what is the market value of the merged firm? So can I say market value is post-merger MPS into post-merger number of share? So if there is a market price of 31.3 multiplied by the number of share people in the class of 3 lakh, sorry, number of share now becomes 6,90,000. 6 lakhs were originally mine, 90 is issued to you. So market price per share is 31.3 multiplied by number of share of 6,90,000 give you the post-merger market value. But in that market value, there is a problem. Do you agree 31.3 is a rounded off number? Because we found 3.13 also to be the rounded off number. EPS was also rounded off, the MPS is also rounded off. That rounded off number, when we multiply to 6,90,000, the level of rounding off become huge, which is why the final answer looks a bit different. In that case, what is the solution? Can I say market value, post-merger market values, post-merger PAT into post-merger P? Do you have the post-merger PAT? Yes, sir. Yes, sir. 18 plus 360, which is 21,60,000, multiplied by post-merger P as 10 times. So 21,60,000 into 10 give you 2 crore 16 lakhs as the post-merger market value. The answer more or less using this formula will also be same, more or less, subject to rounding of error. So, sir, is the post-merger market value done? Done, sir. Determine the profits accruing to both the firms. Now, when it's a profit, I'm confused whether it is gain loss in terms of EPS or in terms of MPS. Now we have learned both. So the logic is really simple. Whenever it is possible to calculate the gain loss in terms of MPS, you have to do it on the basis of MPS. If not possible to do it on MPS, then you do it EPS. Sorted. Sir, do you have the post-merger MPS? Yes. Do you have the equivalent MPS? Yes. Sir, post-merger 31.3 into the exchange ratio give me equivalent MPS. Now the life is easy. Post-merger MPS and equivalent MPS. When compared with pre-merger MPS of 30 and 14, you get the gain per share as 1.3 and 1.65. Multiplied by 6 lakhs and 1 lakhs 80,000 original number of share give you the total gain as 7 lakhs 80,000 as and 2 lakh 97,000. Requesting your responses. Numbers are not very important, but yeah, are you people clear with numbers as well as the flow of the question, flow of the solution? Requesting your responses. People in the class, could I make you people do this comprehensive question? What do you all say? Your validation make me understand, are the efforts making sense, and accordingly I'll be able to proceed ahead. Come on. Live people, you have all your rights to ask anything if you want to ask to me. Recorded people, I hope I'm able to make the things clear to you. Yes, clear, sorted. Can I proceed ahead? Perfect, sir. Sir, the second and third part of this question, right, are not common. They are specifically asked sometimes in some attempts, right? Second part is asked in one of the attempt, third part is asked in one of the attempt. So I would request you to cover this particular part at your own. The commonly asked, frequently asked part is something I've done it for you. Question number 10th gets done. Similar point of learning in the next question is question number 11, where they ask you what is the NPV of the merger and cost of the merger. So let me explain that concept to you very quickly. Everyone, please pay attention. This total gain loss that we have calculated of A limited and T limited in terms of market price or in terms of value, not earnings. The total gain loss of the respective company have two more terminologies. The gain loss of acquirer, the totality gain loss is called as NPV of the merger to acquirer. To the acquirer, it is NPV of the merger. And the total gain loss of T limited in terms of value is also called as cost of merger to A limited. So to A limited, what is its NPV? Its gain. To A limited, what is its cost? Your gain is my cost. The terminologies you have to know, the concept you anyways know. When institute ask this, you have to calculate this. When institute ask this, you have to calculate this, is the only thing you had to know for you to be able to solve more questions being asked in the exam, right? Then is a question which require some formulas, never asked in the question in the exam, but just giving you a sense. Examiner asks you to calculate to find the exchange ratio based on EPS, for which I should have the EPS. But in the entire question, you will never find any, you will nowhere find an EPS. How to do? Sir, which means first I'll have to prepare an income statement. Using income statement, I'll have to find PAT. PAT divided by number of share will be EPS. But how do you create the income statement? Sir, you have inventory turnover ratio, debtor turnover ratio, the closing stock, debtors, everything. You have the gross profit, the operating expenses ratio, everything. How do you do it? Really simple. Sir, once you have the inventory turnover ratio and the amount of inventory, you can find the COGS. I won't solve this question, just guide you how do you solve it. Once you have the COGS, using the gross profit ratio and the COGS, you will people in the class find what? You will find the amount of sales. Are you all understanding me? Once you have the sales, everyone in the class, Once you have the sales and the operating expenses as 86%, accordingly you can have the operating profit, which is EBIT. And after EBIT, you can deduct whatever is the amount of interest on the debenture, whatever is the tax rate somewhere given in the question. Tax rate somewhere given in the question. Where is the tax rate? No. Oh, sorry, corporate tax rate given in the question. You can find the PAT divided by number of share will give me EPS. I didn't want to solve the entire question. Could I give you a sense of what is to be done in question number 14th? Please tell me. The next question we will solve in the class is just give you a sense of question number 16. With respect to the previous question, could I guide you? Using the ratios, you will have to first of all create the income statement. The formula, if you don't remember, let me tell you, COGS divided by inventory is inventory turnover ratio. So if I have the ratio with me, if I have the inventory with me, I can find out the COGS. That is what the thought process in the previous question was. Question number 16 is a variety of question which involves what? Let me explain. Sir, it involves finding out the amount to be paid to you in the form of purchase consideration. It involves finding out the amount to be paid to the target company in the form of purchase consideration. Sir, I acquire you, I am T Limited. So what is the price I am planning to offer to you as E Limited? I am planning to offer to you such a price, means I am ready to pay you such a purchase consideration that business as a whole, which is 7 times of EBITDA reduced by debt discharged by own share at a market price. How much is the value I'm offering to you? Whatever is your EBITDA multiplied by 7 times deducted by debt. If your EBITDA is 115.71 multiplied by 7 gives you overall value of business as 809.97, from which if your debt of 240 is deducted, I will get the value of equity to be paid to you people in the form of purchase consideration as 569.97. How do I give these things to you? By issuing my shares. So it is a stock deal. It is a stock deal, but I will issue my shares at a market price of 220. So the amount to be paid to you is 569 divided by 220 give me 2.59 lakh shares to be issued. Could I successfully do this job of partially explaining only the point of learning of this question? Point here is generally examiner says that okay, if your number of share are 6 lakhs, exchange ratio is 0.3. So 6 lakhs into 0.3 become, for example, 1.8 lakhs. This is how you get the number of share being issued. Now in this question, the number of share being issued, you can figure out using the purchase consideration approach, which is what I was trying to explain. All the live people sitting here, you need to validate to me, could I successfully do it? Come on, come on, come on. So that the next question, and I guess the last question we can do in the class for this topic is question number 17. Please validate the live people sitting here. Are you all there? Are you all connected to me? Perfect. Sir, question number 17 asked repeatedly by the examiner in the exam. Let's see what this question says. All set? All there? Everyone in the class? Can I happily proceed ahead? Yes, come on. So great, guys. The following is the information with respect to two company, Abhiman and Abhishek, right? Abhiman and Abhishek both are promoted by a company called as Trident. How much is Trident holding in Abhiman? 50%, which means how much is if promoter is Trident, so promoter holding is 50%, so rest of the 50% is public in general. In Abhishek, 60% is held by Trident. So rest of the 40% is held by public in general. Fine, sir, sorted, sir. With respect to the two companies, share capital has been given as 200 lakhs and 100 lakhs. Free reserve surplus is 800 and 500. Paid up value, the face value per share is 110. Sir, 110. Free float market cap, which is the market cap which relates to only public in general, which is 50% here and 40% here, is 400 and 128 lakhs, and the P ratio is 10 and 4 times. You have to find the swap ratio based on book value, EPS, and market price, where weights are given as this. Do you all first of all realize the swap ratio is always based on per share parameter? Per share EPS, per share MPS, per share book value. Do you have the total equity shareholder of both the company? Yes, sir. This one is 1000, this one is 600. So equity shareholder fund is 1600. Do you people feel a background noise of disturbance? when I speak, do you people have any background noise which is disturbing you? Please validate it to me. No, na? I can go ahead, which means I can go ahead, right? So my elder sister with her kids has come home, and kids end up forgetting. My studio where I do take these sessions is at home, right? And kids ultimately end up forgetting that they have to keep quiet. So, anyways, so long as it is not disturbing you, I am all happy about it. Yes. So let's go ahead. Fine. Perfect. So I was saying, you have to first find the total book value, which means total equity shareholder fund is 1,600. So this is 1,600. So let's find the number of share. If the share capital is there and the face value, paid up value per share is there, 200 divided by 100 is 2 lakhs and 100 divided by 10 is 10 lakhs. So 2 lakhs and 10 lakh become the number of share. If I have to find the book value per share, it is 1,000 divided by 2, which is 500, and 600 divided by 10 is 60. So what is the exchange ratio based on book value? Target divided by acquirer, 60 divided by 500, which is 0.12. Sorted? Cool. Sir, now let's find about the market price. Free float market cap is 400, which is equal to 50%. So how much is the total market cap? Total market cap is equal to 800. So 128 is free float, which is equal to 40%. So 128 divided by 40% give you 320 lakhs as the total market cap. So if you have the total market cap and if you have the total number of share, can you find out the market price per share? 800 divided by 2 lakhs give you 400 as the market price per share, and 320 divided by 10 lakhs give you 32 as the market price per share. So on the basis of MPS, what is the ratio? 32 divided by 400, which is 0.08. Done. If you have the MPS and if you have the P ratio, so P ratio of 10 and 4, MPS divided by P ratio give you 40 of EPS, 32 divided by 4 give you 8 of EPS, and 8 divided by 40 give you 0.2. So first of all, you have to find these individual parameters of the respective company, and using those parameters and using the weights, you have to do the weighted average giving the exchange ratio of 0.15. First point of learning in this question was to be able to find these parameters. What do you all say? People, quick, yes or no? What do you all say? People in the class, please, quick, yes, no. Settled? Finding these parameters and then finding the weighted average rate. So first you find these parameters of EPS, MPS, book value per share. Then you find the exchange ratio based on those parameters, and then you find the weighted average exchange ratio, which is the first part of this question gets done. The second part of this question involves what is the book value, EPS, and market price after acquisition. Post-merger EPS and MPS is fine, we know. What about the post-merger book value? It's really simple. Questions say you have to assume that asset liability are taken over at book value. So when I acquire Abhishek, asset liabilities are taken over at book value, which means my equity shareholder fund is taken over at its book value. So my equity shareholder fund was 1,000, his was 600. So post-merger equity shareholder fund become how much? 1,600. So my equity shareholder fund plus your equity shareholder fund divided by my shares of 2 lakhs plus against your 10 lakh shares, how many have been issued? Sir, at the rate of 0.15 have been issued. Sir, if you solve this, you get the post-merger book value per share to be 457.14. Now, just one second. Yeah. So the now next one people in the class is post-merger EPS. So my PAT, if you have the earnings per share of 40 and 8, and if you have the number of share of 2 lakhs and 10 lakhs, the PAT become 80 and 80 lakhs for both the company. So my PAT of 80 plus your PAT of 80 become 160 divided by my share of 2 plus issued to you is 1.5, give you the post-merger EPS of 45.71. And post-merger EPS into post-merger P of 10. Post-merger P, let's assume it remain the same, of 10, give you the post-merger MPS. So 457.71 multiplied by 10 give you 457.1. 45.71 multiplied by 10 give me 457.1, give you the post-merger book value per share, EPS and NPS. Sorted with this? Can I take you all ahead? Now the next part. They are saying calculate promoters revised holding. Please remember that out of, listen to this carefully. Sir, out of the 10 lakh and 2 lakh shares, how much were promoter initially holding? Sir, number of share here is 2 lakhs. 1 second. So in 2 lakhs and 10 lakhs, how much were they holding? Sir, they were holding 50%, which is 1 lakh, and they were holding 60%, which is people in the class 6 lakhs. What is the exchange ratio? Sir, this 1 lakh will remain with them as it is, but against the 6 lakhs, they will get it at the rate of 1.15. So 6 into 0.15 give me 0.9 lakh shares now. So after merger, the number of share with them become 1 plus 0.9 as 1.9 lakhs. After merger, how much become their particular number of share? 1.9 lakhs. Out of how many total number of share? Sir, 2 lakhs the acquirer has will continue to have against 10 lakhs total shareholder 0.15 is given, right, which means 1,50,000 shares have been issued. So out of 3,50,000, which is 2 plus 150, out of 350, 1.9 are being held by promoter, giving me their holding, revised holding, to be 54.29%. But I explain people in the class through this basic explanation what is promoters revised holding. Now they are asking what is free float market cap. So out of 350 is 190 is held by promoter. So rest of 1,60,000 is free float. So free float number of share if you have and the market price per share is 457, the free float market cap become 73,136,000, right? Basic. The market price is 457, we know, right? Multiplied by the free float number of share only 160 give you the free float market cap. The last one, people in the class, is really easy. Now they say we have done two more things. Issued the bonus shares and we have also split the stock. When you issue the bonus share, when you split the stock, does your overall book value, which means the total book value or the total PAT or the total market value change? No, only the number of share in the denominator changes. So I have 3.5 lakh share. With 1 is to 2, how many shares I issue more? So I had 3,50,000 share. With the ratio of 1 is to 2, I will issue 1,75,000 more. So I will have total of 5,25,000 share. If one share is now split it to 5 face value, please understand the paid up value initially was 100. If I split it to 5 paid up value, which means one share is to be converted to 20 shares. So 5,25,000 shares multiplied by 20 give you. Now after the split, I will have 1 crore 5 lakh share. From 5,25,000 share, I will have it 1 crore 5 lakh share. So if they ask me post merger EPS and post merger book value, my numerator remain the same. 160 lakhs and 1 crore 60 lakh will remain the same. The total book value, the total PAT remain the same. The number of share in the denominator will change and the EPS accordingly will change and book value per share accordingly will change. Boss, I need a validation. I need a validation. Could you all connect the total numerator will remain the same of the book value and of the PAT. The total equity shareholder fund and the PAT will remain same. The number of share in the denominator will change, and that is how the EPS and book value per share will change. My question to you is how much out of 10 on this particular question, question number 17? Please. Every single student sitting here, you will have to respond to me how much out of 10 on this particular question. Please, please, people in the class. Question 17th is done. 18th is a question you all should do. We are not discussing it in the class. It relates to the question where you have a bank which is being acquired by another bank. The point of learning in these questions are 2 to 3. 1. You have to find the NPA or the exchange ratio using NPA. NPA is a negative parameter. The formula will change to acquire divided by target. General formula is target divided by acquirer, but this time it will become acquirer 5 and target 40. So 5 divided by 40 become the exchange ratio. First point of learning. Second, you will be needed to remember the formula of capital adequacy ratio and the formula of NPA ratio. Except for these three things, 18th question is doable. So you all must visit this question once. Okay? Cool, fine. So these particular questions are done, right? I'll just take one more concept of M&A and one more question related to it, finding the maximum minimum. Since you people already have a rhythm, already have a flow of it, I will tell you how do you find maximum minimum based on MPS. Maximum acquirer says, minimum target says. Acquirer will say, I'm ready to give you such an exchange ratio that my post merger MPS is at least equal to pre merger MPS. Fine. How do you find post merger MPS? Pat into P. So my pat, your pat, synergy in pat into post merger P divided by my shares plus against your number of share, I'll give you an exchange ratio. So I am maximum, I'm ready to give you maximum of such an exchange ratio that post merger EPS so calculated will be at least, sorry, post merger MPS so calculated will be at least equal to pre merger MPS. How in this entire equation, what you have to find is the exchange ratio and that become your answer. Could I please make you people understand the concept? Please tell me. The practical question is extremely easy. I won't even make you people do the entire question, but just show you once, right? I have been given the total earnings of both the companies, the number of share of both the companies, EPS, P, and MPS of both the companies. Find the maximum exchange ratio for C. C in this question is the acquirer, right? C will acquire D. So C will acquire, C is an acquirer, D is target. So C will tell you the maximum and D will tell you the minimum. Fine, sir. Now the question is, we have to find the maximum or minimum based on EPS or based on MPS. The answer is really simple. If they talk about P ratio, obviously P ratio is of use and where in the MPS. EPS has nothing to do with P. Sir, if the P is not there, then the examiner will specify. Or you will have to check the previous part of this question, that in the previous part they are talking about post merger MPS, then you have to do maximum minimum based on MPS. If in the previous part they are talking about EPS, then you have to do maximum minimum based on EPS. Getting my point? So now you have to find maximum. I will say my pat into your my pat plus your pat into the P ratio divided by my shares CCC. My pat 96, your pat 30, right? Multiplied by the P ratio, which is going to be 7, divided by my shares is 20 against your shares, which are 14. We are ready to give you such an exchange ratio that the post merger MPS so calculated should be equal to the pre merger MPS of 38.4. Boss, solution is easy. Exchange ratio finding is easy. My expectation to you right now is, am I able to frame this equation for you based on the thought process that we have learned? I need a validation. People in the class, please respond to me. And then I can say the entire discussion on this chapter of M&A gets done. People, I need how much out of 10 every one of you is clear. Please, please, please. I'm feeling good. I'm feeling that we are able to do the things as planned. We are able to cover those things as planned. So learning these topics covered 12 12 times practical question being asked in the past exams in 17 attempts, giving you good coverage. Right? Let me tell you a particular thing. One might feel that okay, the EPS has been asked only 4 times. It is less important. No, let me tell you, collectively you cannot identify topic wise importance, but you have to identify collectively these 27 topics have been asked in the average, in the marks, in every attempt on an average 67 marks, maximum 88, in the best case, in the worst case 40, but on an average it is 67. I have done complete analysis for you, right? So you can see how were these 27 topics were being asked. Perfect, people. Are you all understanding me? Right? So anyways, we are done with this entire thing on M&A. The next two things that we do are going to be easy for us and are also important, which is swaps and cap floor from the IRRM. People in the class, ready or we all? My question to you all again is same. Are you people comfortable or do you need a 15-minute break? Don't compromise the learning. If you feel a break, tell me. If you're ready to learn, tell me. I'm happy to teach you the things ahead. Come on. Go ahead. No, but what about your dinner? I don't mind anything. What about your dinner? It's 10 p.m. and I'm really sorry I forgot about your dinner. I have my dinner at 6 to 7 p.m. You might laugh, but that's how the Jain tradition is. Since I'm a kid, I've been doing the dinner at 6 max, 5:30, 6:30 kind of. Arjun, you had it at 6? So let's do IRRM. See, after IRRM, we would be left with nothing great to do. After IRRM, if I give break, you won't come back, that I know. Tell me, tell me, am I right to say so? You won't come back after IRRM, that I know. So come on, let's do IRRM happily. People in the class, I'm going to take you to the swap and cap floor. Let me first of all teach you the basic concept of swap, based on which we have a practical question, right? Taking you all to the concept of swap and IRRM. So sir, let's go to derivative and IRRM chapter. Perfect. Perfect. Where is that? Here it is. Sir, sir, in my outnotes, it is around page number 165, right? I'm really sorry for the previous concepts that I taught you. I did not specify the outnotes page number. That's my mistake, right? But those who are class students would be able to connect. Those who are not class students, you will be able to connect directly through my screen, but not the PDF that you have. So I'm really sorry for it. I forgot. Sir, now the swaps. Swaps. Sir, swaps is simply what? Exchange of cash flow. I agree that I will pay you something. You agree that you will pay me something at the end of every period. That can be at the end of every month, at the end of every 6 months, or at the end of every year, right? But what are the cash flows being exchanged? They are the interest amount, right? For example, we have entered into an agreement where I say that I will pay you 8% of fixed, 8% fixed interest rate every year, and you pay me whatever is the LIBOR every year that you pay me. That is what an agreement when entered is called a swap agreement. People, for example, one party say I will pay you 8, another party say I will pay you LIBOR. So that agreement is swap. Now the point of learning, the party who pay fixed is said to have a long position, and the party who pay floating is said to have a short position. Is the first thing clear? The party who pays floating is said to have a short position. Fine, sir. Now, how many times will that exchange happen? If the duration of the swap, for example, is 3 year, and if the floating rate is 6 month, it automatically implies that the settlement has to happen every 6 months. If the floating rate is annual, it implies that settlement has to happen once in a year. So if the total time period is 3 years, settlement is semi-annual. So total 6 times settlement has to happen. Every 6 months, I will pay you 8% per annum. You pay me whatever is the 6 month LIBOR per annum, right? And accordingly we will do an exchange, right? But these percentages are calculated for a notional principle that is also agreed in the contract. Sir, how does the net settlement exactly work? Suppose for the first 6 months the rate is 9% per annum, so I will pay you 8% per annum, you pay me 9% per annum, which means net net you pay me 1% per annum. But how much is that for 6 months? Into 6 divided by 12. So whatever is the notional principal multiplied by the difference between the two rates, the fixed rate and the floating rate for that particular period, the spot floating rate multiplied by the time period, which is your settlement period every 6 months. That simple is the settlement. Based on which we will do a practical question. But before that, let me also teach you there is something called as generic swap. What is it called as? Generic swap. Right. Generic swap, people in the class also called as coupon swap, is a fixed versus floating swap. Two things particularly to remember in this is that the fixed payment is calculated on 30 divided by 360 basis, which means you can say month basis. And the floating payment is decided on the basis of actual number of days divided by 360 basis. For example, there are 3 months. So it will be 90 divided by 360. But if the 3 months has exact 91 days, so it floating payment will be 91 divided by 360. That's how the question of generic swap is. Let's do the first practical question as Let's do the first practical question to be this particular question, question number 68. Let me check if I can find something in terms of timeline for you people on this particular thing. Here it is. Here it is. You'll find it funny, but these timelines make the learning of the class students so simplified. These are from the latest fully recorded, in fact, live taken full English regular batch, right? So 68th question, let's refer to it. Sir, suppose a dealer bank quotes a generic swap all in cost 8/8.2% versus 6-month LIBOR flat. This is the quotation. Notional amount is 1 million for a period of 3 years, reset at the every 6 months. So obviously, if it is 6-month LIBOR, it has to reset every 6 months, right? In this context, answer the following question. Interpret the quotation. So the quotation interpretation is really simple. Dealer who's there to make money, dealer will receive floating, it will pay floating. If dealer suppose enters into a contract, it will receive floating. If it enters into contract to pay floating, it will pay LIBOR, right? So receipt at LIBOR, payment is LIBOR. There is no difference on the floating side, but in the fixed side there is a difference. What is the difference? If dealer pays fixed, it is 8.2%, right? Sorry, if dealer receives fixed, it is 8.2% per annum, but if the dealer pays fixed, it is 8% per annum. Do you understand how is the dealer making money? It receives more, it pays less. That is how the dealer is making money in the fixed side. In the floating side, it is not making money because it is receiving LIBOR and paying LIBOR. Is the quotation first of all clear to you all? So it is a theory question, first to be answered. Second, and that is all in cost. Is there otherwise, other than this 0.2% of difference, is there any cost which the clients will have to bear when they deal with the dealer? No, nothing else. Only this much is what they bear. Where there is nothing in terms of brokerage or anything. Now the next thing, if the firm is buying a swap, what is the nature of cash flow? Which means, sir, who's the buyer of the swap? The buyer is someone who pays fixed. So when a customer pays to the dealer a fixed rate, it is 8.2. So the nature of the swap is paying 8.2 and receiving LIBOR, 6-month LIBOR flat. Sir, when a firm is selling the swap, if I am client to, for example, where my position is short, who's a short position? Who pays the floating, which means you must be receiving the fixed. Now, when the dealer pays the fixed, it is paying only 8%. So, as a client, can I say, client will receive, the seller of the swap will receive 8% of fixed and he will have to pay 6-month LIBOR flat as floating. Again, requesting your responses. The first three parts, which were theoretical, could I explain? Boss, quick. Super ultra fast, the main part which relates to the interpretation of the contract, could I do it for you? Hello? Asked 3 times this particular question in the past. Only this particular question. Swap has been asked more number of times. Could you all do it? Quick, yes, no. Rest of the part, people in the class, now is extremely easy. Next of the part is extremely easy. What does it say? It says that calculate the semi-annual fixed payment for the first 6 months. So I will say, sir, notional principal is 1 million, of which fixed rate is 8.2. So fix you have to find for the buyer of the swap. For the long position holder, you have to find fixed, which means he will pay 8.2. So 1 million into 8.2 for a period of 180 divided by 360 give you whatever as the 41,000 as the amount of interest to be paid to the other party, to the dealer, right? And how much is the floating payment for that buyer? So if I pay fixed, how much I receive the floating? Sir, if the LIBOR is 5, can I say on the 1 million, 5 is what you have to pay. If the exact number of days were turning out to be 181, so you will now say 181 divided by 360. Not 365, it is 360 only. So 1 million into 5% into 181 divided by 360 gives you the amount to be received. Now the examiners say if it is net settlement, how much buyer has to pay or receive? Buyer of the swap, the long position holder, pay 41. He receives 25 139. So net that he pay is 15861. Please tell me, are you people all settled? I need your validation. You have not responded to me in this entire question so far. Are you people 10 on 10 on this question 68? Tell me. If you say yes, the next question I'm going to make you people do understand is the question related to overnight index swap. But for that, I need your validation first. Come on. Am I able to do this question? Like, could I explain this question to you simply? Just give me a second. Just yes. Meryl, you want me to do the theory part once more? Let's take 1 minute extra to do it again. Meryl, you have to understand someone who pays the fixed is considered to have a long position. Cool. And someone who pays the floating is considered to have a short position. So if I am someone who is paying fixed and receiving floating, then think it from the perspective of client. The other party is dealer. When I pay fixed to the dealer, how much will he receive? 8.2 or 8? Sir, he is there to earn money. He will receive 8.2. And against that, how much will he pay to me or how much will I receive as floating? It is 6-month LIBOR flat. Cool. Now imagine that there is one more party out there who is a seller of the swap. The seller is someone who pays the floating rate of interest and who receives the fixed rate of interest. If he has to receive the fix, which means who's going to pay? The dealer is going to pay. When the dealer pays the fixed, he pays a lower amount, which means he will pay only 8%, and he will so when the dealer pays 8, can I say the client will receive 8, and the client against that he will have to pay 6-month LIBOR flat. Meryl, could I do it for you? Please tell me, everyone in the class. Yes, 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 or no? Quick guys, tell me. Yes, great. Thank you, Pratyush. Great. Meryl, clear. So, great, guys. Question number 70th gets done. Now, I'll take you to question number. Sorry, that previous question gets done. Now, I'll take you to this particular question, question number 70. A question on overnight index. Sir, what is overnight index? Let me tell you. It is again fixed versus floating. I pay you fixed, you pay me floating. Only difference is the floating rate is not a 6-month LIBOR or a 1-year LIBOR. It is just 1 day LIBOR. It is just 1 day LIBOR. Overnight, every day there is a rate. So you have to pay me a floating rate of interest every day. But will the settlement happen every day? No, that is the point of learning. You have to pay attention. Sir, you have to not pay me interest every day, but it is calculated every day because the rates of interest change every day. So in that case, will if the interest become due every day, but you don't pay me every day, then the compounding happens and you have to pay me the interest of next day on the opening principal plus the interest of first day. If you didn't understand, let me proceed ahead. Let me explain. Pratyusha, I'm really sorry. I don't get to see your names. I get to see your ID. So it becomes difficult for me to make a name out of those IDs. So thank you so much for letting me know. And I'm really sorry for it. So derivative bank entered into a swap through overnight index on a principal of 10 crores and agreed to receive MIBOR overnight for the fixed payment of the principal. So derivative bank paid fixed and received MIBOR. Fine, sir. Fine, sir. The swap was entered on 2nd August and was to comment from 3rd. So 2nd August was Monday. From 3rd we had to start. So Tuesday is the first day. So Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday and Monday. Since Sunday is holiday, Saturday and Sunday will have the same rate. So for the next 7 days, you will have to pay me floating at these particular rates. I am derivative bank. Cool. So, sir, what is the first day amount of interest for first day? Sir, it will be 10 crore multiplied by 7.75% multiplied by 7.75% into 1 divided by 365. On your calcies, please have the calci ready, please. 10 crore multiplied by 7.75% into 1 divided by 365. Number of days are 365. For one day, the interest become 21233. So please understand, opening principal is 10 crore. On 10 crore, if the interest become this much first day, so the closing principal of first day become 10 crore 21,233. Meaning to say, second day the interest of 8.15% will be charged not on 10 crore, but rather this balance of 10 crore 21,000 something something. And on this amount, when I charge 8.15% for one day, it become 22,334, and the closing accordingly for that day become this. So the principal of every day will be the opening principal of that day plus the interest of that day, making it to be the closing of that day. Requesting your responses. Is the rhythm, is the flow clear? What is to be done for the next 7 days? Come on, quick, yes, no, people in the class. Please, 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 everyone. People in the class. So I want to tell you that this, if you do, let me tell you, for the Saturday and Sunday, you don't have to do compounding. For Saturday, Sunday, on whatever is the principle of Friday, closing of Friday become the opening of Saturday. For at the rate of 7.98% for 2 days, directly you have to calculate the interest. So on this principle, at the rate of 7.98 into 2 divided by 365 is what you have to do, getting the interest of Saturday and Sunday directly one shot. So it is a typical nature of question. You will have to please remember it, kind of, even if I explain the logic. So now you have the interest for the next 7 days, making the total to be 153,740. So as a derivative bank where I agreed into a contract to receive floating, my total floating became 153,740. Now the question is, I have to pay you fixed. You pay me floating 153,740 and I have to pay you fixed. But when we did the net settlement, I received only 317 people in the class net. Do you understand? So can you tell me, I was supposed to receive 153,740, but if I received only 317 net, how much must the fixed be for me to pay to you? How much must that amount to be? So can I say 153,740 minus 317 give you 153,423 as the amount of fixed to be paid to you? So have we found the interest amount under both the legs? The answer is yes. Now we have to find the fixed rate. If you have the fixed amount, so I know that I have to pay you 153,420 of interest, right? Which is only for 7 days. So into 365 divided by 7, get the annual interest. Divide by the principal of 10 crore, give you the rate of interest to be 8% per annum. That was this question 70 on overnight index swap. Could I? Everyone in the class do it for you? Please tell me. Could I? People in the class do it for you? Tell me. Requesting every single live student sitting with me here, are you settled? Yes. So now is the time which really will test your determination, your discipline, your commitment. Because initially everyone is fine, but as we proceed ahead, the things take more effort, and only those who are determined will be ready to make those efforts. Are we ready to do the next question? Question number 67. Yes, one more variety of swap you will learn. In terms of concepts, I will very quickly explain to you what that concept is. Concept is really simple. There are two companies in the market. Both of these companies want to take the loan, right? And both the companies can take the loan in both the formats. They can take the loan in fixed format as well as the floating format. Rigid goes to the bank, fixed rate is 8%, floating rate is L plus 1. Flexible goes to the market. This company, when goes to the market, fixed rate is 6 and floating is L plus 3. When we ask them what kind of loan do you want to take, what is your preference? Rigid says this is my preference, flexible says this is my preference, marked as desired rate, right? So 8 plus L plus 3 give you the total cost under desired rate to be L plus 11. However, if I can make them borrow otherwise, if I don't make them borrow at a desired rate, rather if I make them borrow otherwise, the total cost become L plus 1 plus 6, which is L plus 7%. Do you all get my point? Please tell me. Yes. Now you have to understand, if this is L plus 11, if this is L plus 7, can I say rest of the 4% everyone in the class become my saving? Because rather than borrowing at these higher rates, if I borrow at this lower rate, 4% is what I save. And that is what the flow of this question is. Total cost under desired L plus 11, total cost under actual is L plus 7, and the amount being saved is 4. Cool. Sir, if there is some commission, you deduct it and the net saving become 4. Suppose examiners say you can distribute these savings in the ratio of 2:3. So 4 is the total gain, net gain when distributed in the ratio of 2:3 is it become 1.6% for rigid limited and 2.4% for flexible limited. Now is the main catch. Sir, 1.6 and 2.4 become the amount of saving. Now I would want you to learn how do you calculate the net interest cost. Please understand, for this swap, I cannot explain you the entire story in the class, but I'll try to give you the best possible way I can explain. Guys, when Rigid Limited go to the bank to borrow at his desired rate, at his desired position, Rigid wanted to borrow at a fixed rate. When he goes to the bank to borrow at a desired rate position, how much cost will he incur? 8%. But when we make him borrow, otherwise there is some saving in the cost, and how much is his part of the saving? 1.6. So because of us, after the effect of saving, how much is the effective cost he must be incurring? Can I say 8% is the cost he would incur if he directly borrow at his desired position, minus the saving that he's having by through us is 1.6. So effective cost he must be incurring is only 6.4. Could you connect to my thought process here, requesting your request responses, particularly people? Similarly, flexible, if you go to the bank to borrow at your desired position, it will be L plus 3, but through us you will save 2.4. So L plus 3 minus 2.4 will give you the effective cost that you will have to incur, which is L plus 0.6. Come on, do you understand me? That is how exactly the practical question is. People in the class, the practical question that you have to solve here is question number 67, asked once, and similar question asked twice in the previous two attempts. I'm making you people do a more complicated question, question 67. A question on IF and SF. Shall we? Shall we? So please listen to me. There's this company IF, there's another company SF. If they go to the bank to borrow at a floating rate, the answer is the rate is BPLR plus 0.5. If SF goes to the bank, the rate is BPLR plus 1.5. If they want to borrow at a fixed rate, rate is 3 and 3.5. SF wishes to borrow at a floating rate. So SF floating rupee rate is the desired position. IF wishes to borrow SGD fixed rate. So IF company SGD fixed become desired. So total cost under desired is BPLR plus 4.5. However, if I make them do otherwise, people in the class, total cost is BPLR plus 4, which means otherwise is cheaper, which we can make them do otherwise. Fine. Sir, the amount of loan required is same. The bank allows the important line. A bank arranges swap and require 50 basis point as commission. How much is the saving? Sir, 0.5% is the saving. And that is what they need as commission. Fine. IF, which is to be shared equally. So practically there is no relevance of this line, the commission to be shared equally, because you don't share the commission, you share the gains. Fine, cool. IF require minimum gain of 20 basis point and SF require a minimum gain of 10 basis point. Sir, if the total gain is 0.5, out of which commission of 0.5 is needed, out of which 20 and 10 is to be needed, how will the deal happen? Sir, a bank is very keen to structure the deal, even if it has to forego a part of commission. Sir, some commission if the bank has to forego, it is ready. So we will say cost under desired is BPLR plus 4.5, cost under actual is BPLR plus 4, so 0.5 is saved. Ideally, he required zero point 0.5, the bank, but we can give him only 0.2. Why? Because, sir, 0.3 is what I need to be paid to the parties. So rest is 0.2, which can go to him as commission. So 0.5 minus 0.2 give me 0.3 as the gross savings, net savings, which can be distributed as 0.2 and 0.1 between the parties. So they say whether a swap can be arranged which is beneficial to the parties, where we say yes, it can be arranged, and this is how it will be. Is this particular part requesting your responses, people in the class, clear? Please tell me. Please. Requesting your responses, please tell me. Is it clear? What do you all say? Next part says calculate the effective interest cost. Calculate the net interest cost which they will end up paying. So we say IF, if it borrows at its desired rate, it will be 3% of fixed. IF, when go to borrow to the bank at its desired rate, it will be 3%. However, through us, it will end up saving 0.2. So effectively, what is the cost? It will be incurring 3, it would have incurred, minus 0.2, it's saved. Effectively, it must be now incurring only 2.8. SF, when goes to the bank to borrow its desired possession. One second. Was there a disturbance? Sorry. No, Diwali. There's a marriage garden in near. They keep on polluting. Give me a minute. Really, give me a minute. Can you feel the Diwali vibes, everyone? So the party, it seems, is over, right? It was a quick entertainment. I sometimes feel ashamed and sorry for what these people do to my place. My place otherwise is really calm, full of trees and everything. Just the only part is there's a marriage garden here. And I don't know what kind of celebration is this. In almost all the marriages, 80% of the marriages has this cracker thing. So sad. Anyways, back to the thing. So we were saying that SF people, if it goes to the bank to borrow at its desired position, it will be BPLR plus 1.5. Please pay attention here. It is BPLR plus 1.5, right? But what everyone, if it goes through us, it will end up saving 0.1%, which is 10 basis points. So effectively, it will end up incurring BPLR plus 1.4. Could you understand this particular question, question number 67? Yes, no, quick, validate. The only thing that I need to teach you in this is the concept of people in the class, absolute advantage and relative advantage. What do I need to teach you is the concept of absolute advantage and relative advantage. I'll just teach you that in a minute. Give me a minute. Through this practical question. Sir, if if let's say in the floating market, both of these companies go to take a loan. Let's be now faster. In the floating market, both of these companies go to take a loan. IF is able to borrow at BPLR plus zero point 0.5, whereas SF is able to borrow at BPLR plus 1.5. Can you tell me in the floating market, which of the two companies has advantage? Which of the two companies borrow at a lower rate? So can I say it is IF which has the advantage? Similarly, when both of these companies go to the fixed market, can I say in the fixed market, IF has 3% rate and SF has 3.5% rate. So effectively, again, it is the IF which has advantage even in the fixed market. So when it is the same company which has advantage in the both the markets, we call this advantage to be comparative advantage. When different companies have different when different companies have advantage in both the market, we call it to be the absolute advantage. For example, imagine this rate would have been 2.5, for example. Then can I say in the fixed market, it is the SF. It is the SF which has advantage of borrowing at a lower rate. Then in that case, IF has an advantage in a floating rate, SF an advantage in the fixed rate, and that is how such advantage is called as absolute advantage. So this was a theoretical part asked in this question, that whether any advantage is available or not. So we have to answer whether that advantage is a absolute advantage or a comparative advantage. Could I please explain question number 67 entirely to you, and that everyone in the class completes this discussion needed for this topic of swaps? This completes the discussion. The next discussion that we do, people in the class, is the discussion on cap floor. So let's very first understand the concept really well. Requesting your response. Can we continue to study without taking a break? Or if you feel, you can tell me. I am happy to continue. I am happy to continue with it. Please tell me. Question the concept of cap floor. Are we ready? People, quick responses needed. Tell me, are you all settled with this? What do you all say? Continue. Everyone. Pratisha, you say yes. Bhuvi say yes. Everyone else in the class. Quick yes, no. Continue. So let's do it, everyone in the class. Cap and floor. Cap and floor. Sir, cap is an option to borrow, floor is an option to sell. Let me explain in a very simple way. Let's suppose this is a contract. Let's suppose this is a contract. This contract is a cap contract, which means it has an option to borrow. If I sell this contract to you, your position become long, my position become short. What does it mean? It means that when I sell this contract to you, when you buy this contract from me, it means you have an option to borrow from me. When I sell this contract to you, it is like I have given to you an option that you can borrow from me at a particular rate called as exercise rate. Sir, so how does it exactly work? Suppose exercise rate at 8%, which means you will have an option to borrow at 8% multiple times in a duration of the contract. Suppose duration of the contract is 9 months, but you have an option to borrow right at the rate of 8%, where the reference rate is 3-month LIBOR. What does it mean? The reference rate means that whether I should exercise this contract or not, how do I figure out? I have to compare 8% with the 3-month LIBOR. So if the 3-month LIBOR is 10%, it means rate in the market is 10 and you have an option to borrow at 8. Will you exercise? The answer is yes. Suppose in the next 3 months, right? Do you understand this basic? At 0.0, the rate gets decided applicable for the coming period of 3 months. Then again at the end of third month, the rate applicable for the further 3 months, next 3 months get decided, and accordingly at the end of 6 month, the rate applicable from 6 to 9 gets decided. So suppose in the next quarter the rate decided is 7, you have an option to borrow at 8. Will you exercise? No. Will you borrow at 8 if the rate in the market is 7? No, the option will get lapsed. And similarly in the next slot, suppose next quarter the rate is 8, where you have an option to borrow at 8. Will you exercise? No, because there is no advantage. Meaning to say, first of all, you have to understand, you have to take this decision of exercising every 3 months, because the underlying reference rate is there only for 3 months, which means the contract will get settled at the end of every 3 months, which means it will go for 3 times in a period of 9 months, which is the expiry of the contract, people. Correct? Sir, now, sir, the way cap is an option to borrow, floor is an option to lend. Imagine that this is again a contract in which your position is long, but this time this contract is an option to lend at the rate of 8%, which is exercise rate. If you buy this contract, which means you have an option. When I sell this contract, which means I have given you the option. Correct? If your position is long, you have the option, meaning to say you have an option to lend to me at the rate of 8%, and I have given you an option that you can lend to me at the rate of 8%. This is the interpretation. Sir, if the rate in the market is 10, will you lend me at 8? The answer is no, contract will get lapsed. If the rate in the market is 7, will you lend me at 8? The answer is yes, contract will be exercised. If the rate is 8, will you lend me at 8? No, the contract gets lapsed. So first of all, you should be able to understand what exactly cap and floor contract are. You should be able to understand it on the timeline, that how many times will the exercise or the execution can happen, right? How many rates of underlying reference you will have, and accordingly, when would you exercise? Third, you should be able to understand the position. One is long, who has the choice, another short, who has given the choice. Now, important learning. Sir, how is the settlement? The settlement on the day, at the end of every period, people in the class is gross settlement. Gross settlement, sorry. At the end of every period, the settlement is net settlement, which means adjusting the gain loss. Meaning to say, if the rate in the market is 10, you have an option to borrow at 8, you exercise. How much is the gain you can feel for yourself? 2%. So on the notional principle of 10 million, listen to me, on the notional principle of 10 lakhs, you feel like earning 2%, fine. But do you agree rates are per annum and your time period of settlement is 3 months? So n into 3 by 12, give me the gross amount to be settled for that particular period. People in the class, requesting your responses, could you connect to me? So gross amount to be settled is on the principle of 10 lakhs or 1 lakhs, 2% for a period of 3 by 12 is the gross settlement. You as a long was gaining, you will receive. I as a short will have to pay to you from my pocket. But point you have to understand, everyone in the class, is why would I give this option to you for 3 times over a period of 9 months? Because you have to pay to me a premium at 0 point. So in conclusion, as a long, you will always receive the payoff if you exercise. If you don't exercise, no payoff. As a short, I will have to pay you payoff. Whether it is cap or flow doesn't matter. Cap or flow doesn't matter. If your position is long, you receive the payoff, I pay the payoff. But as a long, you must pay the premium to me, and as a short, I must receive the premium. Then only I will give you this option. That is how the basic positions are. And the cash flow imagination is the last thing you have to learn in this is that, sir, as a borrower, for the purpose of hedging, you will have to take a long position. As a lender, for the purpose of hedging, you should take a long position in floor. So, as a borrower, long cap; as a floor, as a lender, long floor. Now, there is something called as collar strategy. What does it mean? It means that if you're a borrower, as a for the purpose of hedging, you are taking a long position in cap, which means you are having an option to borrow, which require payment of premium. Premium is a cost to me. So what do you also do is that you take a short position in floor. You have an option to borrow is one thing. You give other party an option to lend. You give other party the option that other party can lend back to you. That is collar strategy. Let's solve two practical questions on this, and you will be able to understand what is the flow, what is the rhythm. Taking you to the first question first, right? Question number 57. Not that this question is very important. It is one of the questions previously asked, but this question require efforts to be understood and is comprehensive, which is why we do understand this question. Requesting your responses. Do I have the permission to go ahead to the practical questions? People in the class, please tell me. Come on, come on, come on. Do I have the permission to go to the practical questions? Please tell me. Everyone, people, what do you all say? Only when you are comfortable. So let's do practical question, and then at the end you have to tell me, are you comfortable with the question as well as concept? Sir, MPD Limited issues 50 million floating rate loan. When someone issues the loan, don't imagine it to be the lender. Sir, floating rate loan is a type of debenture. When a company issues the debenture, it is a borrowing actually, if you realize, right? So a company has borrowed effectively 50 million on 1st to July with the resetting of coupon every 6 months equal to LIBOR plus 50 basis point. So what's happening in the spot market, you have to first understand. Then to hedge this situation, we go to the derivative market, and what do? We will figure out. In the spot market, I am a borrower. I have borrowed this much of a principal, 50 million. What is the rate at which borrowed? LIBOR plus 50 basis point is the rate. Cool. MPD is interested in an interest rate collar strategy of selling a floor and buying a cap. Now, for the purpose of hedging, I went to the derivative market. In the derivative market, I bought a cap option and I sold a floor option, which is a collar strategy, right? The period of which is 3 years with the following details. Sir, what are the details? On 1st July, we entered into this contract where 50 million is the notional principal, which matches with the spot market. Cool. 5% and 8% of floor is the strike rate. Option to borrow, I have at the rate of 8%. Option to lend, I have given to the other party at the rate of 5%. Fine, sir, 6-month LIBOR as the reference rate has been given, and the premium is nil because what I pay is equal to what I receive on the long and short positions. Cool, sir. On the reset date, right, the interest rate turns out to be 31st December 18 is the first reset date. Now there is this complication in this question. I call this question to be a bit ambiguous because my first date is 1st July 2018. So accordingly, my first reset date should be 1st July 18, but unfortunately the first reset date comes out to be 31st December 18. So if December 18, 31st December 18 is the first reset date, then the payment date or the settlement date should be, the first settlement date will be after 6 months, which is 30th of June 19. Are you understanding? First reset date is 31st December 18, then therefore the payment date is 30th June 19. Right? Sir, what's going on? Let's understand. They have given me at the end of at particular dates, right? The next 6 reset date, the LIBOR turns out to be 7, 8, 8.5, and so on percentages. You have to find the effective interest paid at each 6 reset date, right? In each of the 6 dates, right? In these 6 different scenarios, what is the effective interest paid? What do you mean by the effective? Effective means effective of the 3 situations, 3 positions, net of the 3 position. One, what you pay in the spot market as a borrower. Second, what you receive on the long cap, what is the payoff you receive on the long cap. And third is what is the payoff you pay, gross payoff you pay on the short floor position. So net of the 3 position, how much? First thing. Second, you have to understand in this question, since the date has been given, you have to do the day wise calculation. Sir, what do you mean to say? My first, if reset date is 31st of December, my first date become 1st of Jan. So from 1st Jan to 30th June, I have 181 days, right? For that period of LIBOR is 7%. So in the spot market, I will have to pay 7.5. So on 50 million, look at me, 50 million on at the rate of 7.5%. For 181 divided by 365 days in the spot market, I will have to pay 18,59,589 as the amount of interest. Cap lapsed, floor lapsed. Why? I have an option to borrow at 8. Rate in the market is 7. Will I borrow? No. I've given an option to the other party to lend me at 5. Other party can lend me at 5. Rate in the market is 7. Will he lend me at 5? No. So it gets lapsed. That's how the net of the 3 market is 1859, 589. Now I'll tell you the point of learning specifically. Please pay attention. First, in the third case, you will observe that there is a leap year. When 31st December 19 is the reset date, my reset period will be next 6 months. 1st Jan 20 to 30th Jan 20. Do I have the February month of 29 days? Yes, which is why the number of days will be 182. 1st Jan 20 to 30th June 20 will be 182 days. Denominator will be 366 days, right? And accordingly, people in the class, the interest to be calculated will be this. Next calculation, first calculation is this. Next calculation, rate in the market in that case become 8.5. I have an option to borrow at 8. Look at the calculation. I have an option to borrow at 8. Rate in the market is 8.5. Will I borrow? Yes. How much is the gross gain do you feel for yourself? 0.5%. So of 50 million, which is my notional principal, I will say 0.5% is the amount of gain I will have. For 182 divided by 366 days will give you the call payoff. Whatever is the amount, requesting people in the class your responses, please do you connect. So I will say 50 million multiplied by 0.5% into 182 divided by 366 give me 124317. 124317 is the amount of payoff I will receive on call. This spot market interest I was paying, the amount of payoff on call I will receive, so it has to be deducted, and net is the this interest I incurred. At this point, I will require validation. Could I explain this particular thing to you or not? What do you all say? Everyone in the class. Come on, please. Please, please, please. Could you all connect it to what I'm saying? What do you all say? Understood? Connected to me, right? Similarly, another point of learning, when 30th June 20 was the reset date, the settlement period, the reset period was 1st July 20 to 30th 31st December 20. First, numerator will remain without leap. It is normal calculation because there is no Feb in July to December, but denominator will continue to remain 366 because that calendar year is the leap year. That is the first thing you have to remember. That calendar year is the leap year, so denominator continue to remain 366. This question is quite typical in nature, but you have to please accept it, right? Second, so accordingly the calculation will happen. Second is about the floor. Sir, rate in the market is 4.75, right? You have given the option to the other party, that other party can lend me at 5. Please have the thought process. If rate is 4.7, the other party has an option to lend me at 5. Will the other party execute the option? Will that lend me at 5 under the contract? The answer is yes. How much is the gain? The other party has 0.25%. So other party gain is my loss, which means I will have to pay it from my pocket. So overall, everyone in the class, can I say 50 million into 0.25% into 184 divided by 366 days? 184 is normal. July, August, September, October, November, December, normal. 184 divided by 366 because Feb is a leap year, and that is how the calculation is, and that is how the amount on floor I will have to pay. The only things which were needed to be taught in this question to you were these things that I have discussed. When is cap exercised, when is floor exercised, the concept of leap year and everything, and the amount to be paid in the spot market. How much out of 10 on this particular question? So that's how we have at the end of every settlement date, how much is the effective interest net of three markets to be paid overall. How much out of 10, everyone? I need your validation. I need your responses, please. Come on, come on, come on, come on. Everyone. You don't, I mean, I have no, it's all right for me to take time, but it's not at all fine with me, for me to be not able to explain anything to you. That's the simple thing here. Connected to me, everyone? What the next thing examiner asking is the overall average overall effective rate of interest. So first of all, rate of interest is percentage. Then it says per annum. So average per annum rate that you have to find of overall 3 years. So I will say the overall amount of interest paid over a period of 3 years is this much. How much is the number of days that has happened over a period of 3 days? 3 year is 1096 days. So I will simply say this is the amount of interest for a period of 365 days. How much does it become? It becomes 365 divided by 1096. So I get this to be the amount of interest per annum. divided by interest divided by the borrowing amount of 50 million give me the rate of interest as 6.87%. That everyone in the class is B part of this question. Question number 57 we have done, right? This was one question we have done. Just one question we do and the entire thing of swap will be done. That's an easy question. Question number 55 asked in the attempt of Jan 26 exam. How many of you are at this point watching me live ready to do question number 55? Yes, boss. Or. Let's do one thing, everyone. Let's take a break. Let's take a break. Let's do question number 55. All right. Post, let's take a break and then do question number 55. Then do the concept, one question on value at risk, one question on economic value added, one question on Macaulay's modified, and if needed, one question on NPV calculation. Right? So, who all are live at this point watching me up is what I want to know. Come on. People in the class, who all are live. So, it is 11 right now. Let us take a 10-minute break. Let's meet back at 11, 10, 11, 12, whatever time you come back, right? And then we continue rest of the things. I believe before 12 we should be able to do it. All right. So I understand it to be a very effective thing, but I would request you all to come back, because not that economic value added is less not that exponential moving average is less important, or the another question of cap floor or value at risk is not important. All these things have been asked. All right. So please go for a break. Come back in 10 to 12 minutes and then we'll continue. All right. Bye, people. all there? Back everyone in the class, please. People, come on, come on, come on. Are you people there? Back after the break? Yes. So what do we have to do now? We have to, people in the class, solve this particular question on cap floor asked in the attempt of Jain 26 and then do these small things. The understand the concept and practical question. Who all are back? You have to tell me first. So Arjun I see is there. Meryl is here. Who else is here? Bhuvi is here. Great. Who else? Great, 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 great. Come on. Others in the class, please tell me, are you all there? In the meantime, we are starting to solve question number 55. Asked in the attempt of Jan 26, I will go to the new question by ICAI file where we have presented this question in a better way. So this is here, this particular question is 15th. And in fact, let me tell you, let me take this question to you from the latest regular batch handmade notes. Here it is. So question 55. Pratyusha is also here. So come on everyone else, let's focus. Let's go ahead everyone. There are two companies, AB Limited and XY Limited. The status of the first company is that it is a borrower, another company is a depositor. Principal amount involved is 5 million and 2 million. Duration of loan is 5 and 3. So one party wants to borrow for 5 years, another party wants to deposit or lend for 3 years. The rate of interest applicable is prime lending rate plus 3% plus 0.5%, and for investment it is prime lending rate minus 0.5%. Fine, sir. The strike rate is 8 and 8%. Sir, why do they talk about strike rate? Which means there must be some option now, call or cap or floor, because without cap floor, the strike rate is nothing. Cool. Premium that is to be paid lump sum. So we know the premium is paid lump sum at the start of the contract is 0.4 and 0.5% of obviously the notional principal. If PLR rate at the end of first 6 months, sir, at the end of first 6 months, imagine that this is 0 month, this is 6 months. So at the end of first 6 months, if the rate, if the prime lending rate, people in the class is 10%. So if I assume my reset period to be next 6 months, so if I assume my reset period to be the coming 6 months, so I will say at this point, if this is my reset period, so 10% is the rate of interest that prevails in the market. Cool. Elaborate the strategy to be adopted by both the companies to hedge the risk. So strategy to be adopted is really simple. We will say AB Limited is a borrower in the spot market, therefore it should buy a cap option to hedge. Similarly, XY Limited is a depositor, therefore it should buy a floor option to hedge. You must be thinking, sir, how do you know it is cap and floor in the strategy? It can be FRA, it can be swap, it can be anything. But the strike rate and premium comes into picture only when there is a cap floor option. Next. How much is the premium paid or received based on the strategy adopted in first part? So you are saying you should buy a cap. The premium is 0.4%. So how much is 0.4% of 5 million? 0.4% of 5 million people in the class is 20,000. Similarly, the premium is 0.5% of 2 million. The premium is 2 million into 0.5%, which is 10,000. But now there is a catch here regarding which the examiner is silent, but it has done something. You have to pay attention to what I say now. People in the class, please pay attention. What it says that at 0 point, if you pay premium, right, it is a premium applicable to all the reset period. So in the first case, in case of AB Limited, the total life is 5 years, where every reset period is 6 months. That is what examiner has explained, which means, can I say in total there would be 10 period of 6 months each, making the total time period to be 5 years. Cool, sir. So this premium logically should be allocated to different periods, right? To all these periods equally, so that we can get to know how much is the amount of premium equivalent to one particular period. How do you do it? Really simple. Sir, we can assume this amount every year to be annuity, whose present value we can see is the right now amount of premium. So general formula is amount of annuity into present value annuity factor is the present value, which is premium. So if premium I know is 20,000, if the present value annuity factor, now please pay attention. For doing present value, they want you to use 8% as the reference rate. Something examiner is not clear about, but you have to understand that 8% per annum is the rate to be used as present for present value factor. So I will say in 5-year total, there are 10 period. One rate per period become 4% 6 month. So present value annuity factor for 10 period at the rate of 4%, right? If you have, it is 8.111. The present value is 20,000. So how much is the amount of annuity or the amount of premium per period? It is 2465.79. So in the first part, you don't have to calculate the total premium, but also the premium applicable to one particular period. Similar thing you do for the another company, that is doable. Now the third part is how much is the net gain loss due to hedging, which means net gain loss as an after the effect of premium. In the second 6 month, if the rate become 10% and the strike rate is 8, which means I have an option to borrow at 8 rate and the market is 10, will I exercise? Yes. How much is the gain I feel for myself? 2%. So 5 million into 2% for a period of 6 by 12 become 50,000, right? 5 million into 2% for a period of 6 by 12 become 50,000 as the amount of gross pay of receipt. But for that, how much is the premium applicable for that particular period? It is 2465. So the net premium is 47534.21. That is the net gain I could have after the amount of premium I have paid. Yes. Aditya is saying, why have you done 8 minus 10? Is really simple. Aditya, rate in the market is 10. I have an option to borrow at 8 because cap option is strike rate or exercise rate. One and the same thing is 8%. So do you agree? Do you agree? This is how much is the gain you could generate. It is 10 plus 0.5 minus 8. No, 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 no. Please understand, spot market has nothing to do with the derivative market. This is my rate in the spot market. But the cap floor takes place in the derivative market. And in the derivative market, strike rate is only 8%. Right? I have to compare 8% with the prime lending rate, right? So that is to be compared with 10. It has nothing to do with a spot market of PLR plus 0.5. Could I answer your question, Aditya? Everyone else requesting your response, could you understand what this question 55 was? So the way we have done it for AB, similarly for XY, you will have to do the thought process remain the same. Quick, quick, quick. Everyone, are you people settled? Can I take you all ahead? So with this, what gets over is this discussion on cap floor options. Yes. Similar nature questions have been asked 4 times in total. Now I'll take you to another basic concept, the concept of value at risk. Right? So Shamul says, can we always do this? What do you mean by always do this? What this means, what is my question? Ignoring, yeah, always, it is obvious. Always for the purpose of deciding whether you want to exercise something or not, or to find the gross payoff, you have to compare the exercise rate with the reference rate. If reference rate is LIBOR, you have to compare it with the LIBOR. Even if in the spot market you are paying LIBOR plus 2, LIBOR plus 0.5, whatever. That's a fact. That's how you have to always do it. Cool. Taking you all people to the next discussion, a very simplest formula, the formula of value at risk. So let me take you all first of all to the OutNotes, where this concept of value at risk is there. Right? We won't understand the entire concept, but we will focus on how does examiner ask you question. Examiner will ask you a simple question that imagine that examiner gives you a particular investment has a standard deviation of say 5%, right? Which means it deviates by 5%. Then examiner people in the class says that at a particular confidence level, say 96% or 99%, the value of Z is something. Sir, value of Z, suppose it gives you 2.33 times. So what does it mean? It means that the amount of maximum loss the amount of x minus x bar, which means the amount of value at risk or the amount of maximum loss, everything mean the same, will be 2.33 times of the standard deviation of 5%. So first of all, have you learned how do you calculate the maximum loss? Sir, it is Z into the standard deviation. Cool. That is one way to ask the question. Another way to ask the question is that examiner give you the maximum loss. It will give you the standard deviation. Using it, you will find the Z value. And for that Z value, you will have to give to the examiner the probability. Now, sir, what is this linkage between Z value and probability? It comes from the table. You don't have to remember anything in this. Cool. Fine, because there's a table that for the Z value area is this, probability is this, for the Z value the area or the probability is this. Fine, sir. Sir, what is the value of the portfolio? What is, people in the class, the value of the portfolio? Sir, let's suppose I have that amount of maximum loss is 5 multiplied by 2.33%. So 2.33% times into 5 give me 11.65% is the maximum amount of loss which can happen in percentage terms. So can I say if I have a value of 1 crore or 1 lakh rupee where the maximum amount of loss can be 11.65%. So overall, people, if maximum loss is 11.65% of 1 lakh rupee, so in rupee terms, how much will the maximum loss be? In rupee terms, how much will the maximum loss be? 1 lakh into 11.65, which is 11,650 rupee. Now, third case, suppose at present the value is 1 lakh rupee. The existing value of the portfolio is 1 lakh. Maximum loss can be 11,650. How much can the minimum portfolio of the value be? 1 lakh minus 11,650, which is 88,350, I guess. 89,350, whatever. 88,350 or whatever, 89,350. Do you understand what are the basic formulas we have to understand? Quick yes or no. Let me take you to the practical question. Let's look at the execution of this formula and then you will realize how it goes. Right? I will take you to the practical question of risk management. Come on, everyone. I will take you to the practical question of risk management. Question number 6 is one such question that we can do. It is the most comprehensive question. Cool. What does the question say? Let me explain. Question says Mr. Bull is a rational risk taker, right? He takes the position for 4 days in a week. He does not take the position on Friday to avoid weekend effect, whatever it is. He takes the position from Monday to Thursday. He transfer the amount to Monday morning and withdraw the balance on the Friday. Sir, he has a bank account. From his personal bank account to another bank account, he transfer an amount in the Monday morning. Based on that amount, the position is to be taken in the spot in the stock market. Cool. Sir, this line is important. He desire to make maximum investment where value at risk should not exceed the maximum balance lying in his bank account. His bank has a balance. He want to buy the investment for such an amount that the maximum loss, what is value at risk? What is an alternative word for value at risk? It means maximum loss. So he want to make such an investment that the amount of value at risk, the amount of maximum loss should not exceed the balance lying in his bank account. Fine. The position by his manager as per his trending instructions taken on the free balance lying in the bank account. In the bank, whatever is the free balance lying, that is kept in mind by the manager as the standing instruction that should be the considered as the maximum risk. Accordingly, you take a position such that maximum risk is this. Fine, sir. Cool. On Monday morning, before opening of the capital market, he transferred an amount of 11 crore to his bank account. So he has transferred to that particular bank account from where the maximum loss is considered 11 crore. FD also matured on Monday and the amount becomes 63,42,560, which was also credited in the bank account. So as per manager, according to manager, what is the standing instruction? Take the balance, take the position based on the free balance. So now free balance become 11 crore plus 63,42, right? There is a line, it says that Mr. Bull received the intimation of that FD redemption, right, in the evening. Even if Mr. Bull got to know about that FD redemption in the evening, to the manager it doesn't matter, because according to manager he has a standing instruction that I can take the position for the free balance. Fine, sir. The bank balance minimum needed is 1,000, which is minimum bank balance which is needed. Sir, the value of Z score at the required confidence level of 99% is 2.33. The information regarding X and Y stocks have been given. Now I'll tell you one by one what's happening. I had 11 crore rupee in my bank account. Matlab I transferred to a particular bank account 11 crore. 6342 560 the FD got redeemed, matured, and 1000 was the minimum bank balance required. So the available bank balance which can be equal to the maximum loss is 116341 560. Now we have to figure out how much is the maximum loss in percentage terms that can happen to me. Can I say maximum loss is Z multiplied by SD is equal to maximum loss? Maximum loss divided by SD is equal to Z. So SD into Z is the maximum loss. Sir, do I have the SDs given to me? No. We have to apply portfolio management. Listen to me. Listen to my thing very carefully now. People, returns have been given and the probability have been given. How many of you are able to recollect portfolio management? If possible return and probabilities are given, can you not calculate the X bar? And accordingly, sigma X, the standard deviation using the possible returns using X ante probability distribution. Yes or no? Shamol, is that your first name? Shamol? Why have you suddenly become emotional and started to thank me for my efforts? Why suddenly? Right? Everyone, can you all please connect to my thoughts? Similarly, if you have a security, its possible return and its probability, can you not calculate the expected return X bar and sigma X variance and standard deviation and everything? Can I assume that I don't need to teach you that using the given return, how do you calculate standard deviations and everything? That much can I assume? Such a basic thing. Now you have to understand. Examiner first of all made us calculate SD rather than directly giving us. This was the first point of learning of this question. Second is very important. First, that there is this hidden assumption which is, you can consider it to be an ambiguity. There is this hidden assumption which you can consider it to be an ambiguity that sir, that this given data is for 1 day is what examiner has assumed, which means these possible returns and probability is assumed as the data of 1 day, which means the standard deviation that you will calculate using this table will be a 1 day standard deviation. Do you understand my point? But in my case, I will have to calculate the value at risk for 4 days because my investment can fluctuate from Monday to Thursday over a period of 4 days, right? So second point of learning in this question is learning to calculate 1 day SD into 4 day SD. So please always remember, you can never convert anything from one to another at SD level. You have to do it at variance level. So I will first of all say my 1 day variance in case of security X is 1.3. So how much is 4 day variance? You can convert this from 1 day to 4 day at SD level. You have to do it at variance level. So 1 day variance is 1.3. So 4 day variance become how much? People in the class, 1.3 into 4 become 5.2. So 4 day SD become how much? Under root of 5.2, which is 2.28%. So in 4 days, if my fluctuation on an average is 2.28 times, how much is the maximum fluctuation? How much is the maximum loss? I will say 2.33 times of SD. How many times? At 99% confidence level, I can say maximum fluctuation is going to be 2.33 times. So 2.33 times multiplied by 2.28 percent the average fluctuation. So maximum loss is 5.3124%. At this point, if you validate me, the next line is really easy. If I speak, the question gets over. For that, I want you all to respond to me. Could you connect that maximum loss in percentage terms which can happen to me is 5.3124%? Come on, yes, no, please. Examiner asking, what is the which single stock where we can make maximum amount of investment? So what are we going to say? We are going to say, we are ready to make such an investment X amount, which if deviates on which, if the amount of loss is 5.3124%, the loss in absolute terms become 1163,41560. Do you agree? How much that amount of investment should be on which a 5.3124% is the loss? The loss should be 1163,41,560. It should not exceed this amount. So this X, can I say 1163 divided by 5.3124 giving me 219 crore? So according to the available bank balance, which can be maximum value at risk, that can be maximum loss, how much is the amount of investment, people in the class, can I make? I can make 219 crore in security X. And in security Y, similarly, how much investment you can make? 114 crores only. Why? Please observe, security X deviate by 10.2054%. How much is the SD of security Y? 4.38. How much can it deviate? 2.33 times, which means 10.2054. So when security Y can deviate more, let's invest less in it. That higher deviation can restrict my loss to 1163. So 1163 divided by 10.2054 give you this amount of investment that can be made. So I will say higher investment can be made here. This is what is to be chosen. Except for that, it is a one-day standard deviation. Everything is sorted in this question. Could I successfully make you people do this question of risk management, value at risk? All the live people sitting here, please tell me, could I successfully do it? What do you all say? My next concept is going to be super easy, but for that you need to validate me first that are these efforts making sense to you? Yes. Next concept, the concept of economic value added, extremely easy. I don't need to show you a formula. I will just directly take you to the practical question from where we will build this concept. Let's do question number 9 on economic value added. So you will observe recently asked 2 times and recently asked 2 more times. So that's how 4 times in the past 17 attempts, right? So let's do it, people. Sir, this question is from the chapter of security analysis, right? So those who are doing the time stamping, let me tell you, we are done with risk management, value at risk. Now we'll be doing security analysis, exponential moving average. Exponential moving average is simply calculating the weighted average. What it is? Calculating the weighted average. Weighted average of what? Weighted average of share prices, right? Sir, suppose that Nifty is an index, right? You don't have to suppose. Nifty is an index whose at the end of these dates, the closing Nifty values were these. Fine, sir. You have to, for this, find for a exponential moving average. An exponential moving average involves doing weighted average. Sir, weighted average means, sir, to the price which is today, you have to give some weight, for example, 10%. And to the previous average, examiner will always give you the previous moving average for the month of December is 17,174. Please try to connect, people in the class, pay attention. I will say on Jan, in the start of the Jan, the index value has been this in the start of the Jan. So previous average of December is 17,174. So exponential moving average involves doing weighted average in a very unique way. On 3rd of Jan, which is my first day, how do you calculate the average of that day? This particular price is given some weight, for example, 10%. And previous average is also given some weight, say 90%. So this today's price into some weight and the previous average into some weight give me the weighted average of today. Are you understanding? Next day, I will say, okay, this particular price become the price of 4th Jan. So this price will have a weight of 10%. And now what is the previous average? This become my previous average. It will have a weight of 90% and 10% of today's price and 90% of previous average become the average of today. Do you understand how simple this concept of weighted average is? Now the question is, how do you find that weight? How do you find that exponent? For which we have a mechanical formula which says if you want to calculate a 15-day average, don't get confused. 15-day average has nothing to do with the number of days given here. Number of days given here is a different story. You have to, if calculate 15 days exponential moving average, it is 2 divided by 15 plus 1, which is 2 divided by 16. This is a formula you have to always remember to find the weights to find the value of exponent referred by A, denoted by A. So 2 divided by 15 plus 1 give me 12.5 as the value of exponent. It means that today's price will be given a weight of 12.5% and previous average will be given a weight of 82.5%, right? Let's people in the class solve the one thing on the calci and you will get the confidence that even if the presentation is secondary, do you get the concept or not? So I will say 17626 multiplied by 12.5% m plus and 17174 multiplied by 87.5% M plus. Memory recollect is 17230.5. Do you get this number on your calci, please? Let's do next one. Let's do next one. I am okay with it. Sir, 17805. So 17805 is the price of next day multiplied by 12.5% M plus. And now the previous day become the first day. So first day's exponential moving average, which is 230.5 multiplied by 87.5% M plus give me 17302.32 on a 31 on a rounded off basis as the moving average of next day. So what you have to simply do is the moving average. Look at the formula. Exponential moving average of today is the price of today multiplied by 12.5% plus exponential moving average of t plus 1, t minus 1, matlab previous day means last day multiplied by 1 minus weight, which is 87.5%. That is how you get the exponential moving average of every day. Requesting people in the class your responses, please. Could I make you people understand what it is? Come on. That simple the thing actually is. This was the concept, this was the flow, this was the formula, simply doing the weighted average. Once you validate, I will proceed ahead. If you don't validate, I am all fine to be here. Come on, everyone. Do you validate it to me? Are you all able to connect what we have done? Simply the weighted average. So question involves first understanding in the exponential moving average, we have to calculate exponent. That exponent require n. So if it is 15-day moving average, n is 15, that is first learning. Second, you have to simply do a weighted average. Average of today and the previous exponential moving average. Simple. That is the flow, easiest flow to solve question number 9, which is the only topic frequently asked in this chapter of security analysis, right? The concept of exponential moving average. In this question, there was part B also, but explaining that will take things to some other direction. So it's a theoretical part. If the question is asked for the 6 marks, 5 marks will be for the main part and work marks will be for the last part, theory, which we are not referring to. I'm being transparent whatever I've been doing. Cool. Now I will first explain to you Macaulay's modified duration and then I'll explain to you NPV calculation as the last thing. Right? Because NPV calculation we may not do. I will explain what it is. Okay. Shalini, got it. Thanks so much, Shalini, for your understanding. My eyes are kind of burning because in Indore at my place, the temperature is, I'm not sure, but I think 44. Okay. And the studio from where I take this session is on the terrace, top floor. So that burning heat, heats up the studio entirely. My AC, unfortunately, I'm not able to use, which is why it's quite it's quite hot here. But so long as you people get the benefit of what I do, all these things never mattered to me. If I'm sweating, not sweating, how do I feeling, not feeling, all that doesn't matter. Only thing I want is that these efforts should advantage more and more students. Is the only thing I can tell you. Thank you so much, Aditya, for your appreciation. I mean, good that we are talking this. But yeah, great. Back to the point. So, taking you all to the next discussion, which is the fixed income security. It is a matter of next 15 minutes now. You all have to be there with me completely. Let's do people fixed income securities. In this entire chapter, what do you have to study? You have Macaulay's duration and modified duration asked by the institute. Again, these things, people, I will explain to you through questions, because even if I take you to the concept, there also what we have done is an illustration only. Okay, for example, if I take you to the concept of fixed income security, what you'll be able to find there is an illustration only. This is an illustration, people in the class, on the Macaulay's duration and modified duration. Cool. So taking you all to a practical question where we do this. So that is the practical question number. Here it is. Perfect. Question number 31. Question number 31. One question on modified Macaulay's would be sufficient. There are we all. Just out of my curiosity, can you all tell me how many of y'all are there, people? How many of y'all are still there live with me? At 11:45 at night, after your FR exam, Pratyusha is here, Shalin is here, Aditya is here, Esther is here, Arjun is here, Sairam is here, Meryl is here, Chandu is here. Great, you guys have done. Varsha is here. Great, great, great. Perfect. People in the class, let's proceed ahead. I appreciate personal appreciation who's watching it by pushing yourself beyond your capabilities. That's really great, everyone. Let's proceed ahead. So as saying, question number 31, through which I will explain to you Macaulay's as well as modified. Please pay attention. Following data relates to a bond. There is a bond whose face value is 10,000 rupee, which is to be redeemed at par on maturity. Fine, sir. Then there is a coupon rate at the rate of 8.5%, years to maturity is 5 year, and YTM is 10%. You have to first calculate the price of the bond. Can I say price of the bond is the present value of future cash flows? Imagine the future cash flow. 8.5% of 10,000. 10,000 into 8.5% is 850. So 850 is the amount of coupon to be received in the next 5 years, and 10,000 is the amount of redemption value to be received at the end of 5th year. Fine, sir? Align. We have to first find price, which is fine. Then we have to find Macaulay's duration. Now, whenever examiner asks you for the Macaulay's duration, you have to first find the price. But you don't have to discount all the coupons using annuity factor. You will have to rather discount the coupons manually, individually. So I'll make this table. I will say for the next 5 years, how much are the amount of cash flow? So 10,000 into 8.5% is 850, 850, 850, 850 and 10850 as the amount of cash flows, right? The discounting rate is 10%. At the rate of 10%, the factors which are given to me is 0.909, 0.826 and these are the present value factors. Multiplying cash flows with the present value factor give me DCF, right? Which is the adding which gives me the value of the bond. Can I say till this point what we have done is the valuation of the bond, nothing beyond it. What I explain now, everyone in the class, what I explain now is what will be the Macaulay's duration, then will be modified duration. How much is the amount that you have to pay for the bond today? 9431. Fine, sir. Cool. This is the amount you have to pay for the bond today. Next. Sir, the amount that you pay today, this much, how would you be able to recover it over a period of time? For example, in the first year, you recover 850. But do you agree, in the first year, if you recover 850, that is future value, that is inclusive of interest. What you would want to recover, so how much is the amount recovered today? In today's terms, is the present value of it is 722. At the end of first year, if you receive 850, that is inclusive of interest. Let's discount that amount and find out how much of it is recovered in present value terms. So it is 722.65. Point is, people in the class, 9431, that amount which you pay today, of that amount, 722 is what you are able to recover by first year. By second year, you'll be able to recover 702. In the third year, you'll be able to recover 638. In the fourth year, you'll recover 580. And in the fifth year, you will recover 6737. And that's how you will recover your entire amount of 9431.5. This rhythm, if you understand the formula of Macaulay's, you will understand at your own. What is the rhythm? Rhythm, people in the class, simply is how much is the weighted average time taken. Different in different time, different amounts got recovered. So on an average, how much was the time taken to recover this entire value of 9431.5 is the answer, is what Macaulay's duration is. So I will say these are years, this become my weights, because these are the weights when these years, you know, weights which can be allocated to these year, accordingly the amount got recovered. So I will say year into weight is DCF into weight. One second. Year into DCFs are the weight. So year into weight, when I do the weights, people in the class are absolute. So year into weight give me total as 40,130 divided by sum of DCF, which is sum of weight, give me the weighted average. So 40,103 divided by 943 give me 4.252 years. I will stop here. I will first ask you, everyone, do you people realize that Macaulay's duration is the weighted average time taken to recover the value of the bond that you pay today as the price? Come on, can you feel how is the weighted average done? You have to respond to me on this. Accordingly, I'll be able to proceed ahead. Come on. I'll be able to proceed ahead, but you will have to first respond to me on this. Quick, yes, no. Can you feel the weighted average? Anyone, any scope of doubt, you'll have to please ask me, no compromise at all. Perfect. Next. Sir, Macaulay's duration tells you the weighted average time taken, and modified duration, how do you calculate? Simply as Macaulay's divided by 1 plus YTM. Macaulay's duration is 4.252 years divided by 1 plus YTM, which is 1.1. YTM is 10%, gives you 3.685 as the modified duration. Now is the most important thing. Do you know what is the meaning of modified duration? It tells you sensitivity, means for every 1% change in YTM, does the bond price change? Yes, sir, bond price change in the inverse direction, opposite direction. But by what percent? By Macau modified duration by 3.685%. Do you understand? What does it mean? If bond price increase by, if YTM increase by 1%, the bond price will fall by 3.865%. If YTM fall by 1%, then bond price increase by 3.865%. That is how, people in the class, it is. So now everyone in the class, in the next part, examiner, convexity we are not doing. Convexity is not the topic being included in that. The topic that's being included, people in the class, is Macaulay's and modified duration, right? So convexity we are ignoring here at this point. What? What? No, convexity is entirely different as compared to modified duration. The two different things. If you want to understand convexity, then you'll have to go to my revision videos. For full English, chapter-wise revision videos are available. You can refer to them. Okay, okay. Now, sir, sir, now you have to find out the expected market price if the YTM decreases by 200 basis point. But how do you have to find out? Is it that you have to now consider YTM to be 8% and recalculate the price? That is option 1. That is by intrinsic value method you have to find out. Assume YTM to be 8%. Let's make the discounting rate to be 8%. Refine the present value factors and do the valuation again. Another option is to do it using Macaulay's duration estimate, which means using modified duration estimate. So what is the common sense? Common sense is when YTM fall by 1%, people, bond price increases by 3.865%. So if YTM fall by 2%, then how much will the price increase by? Can you feel the common sense? 3.865 multiplied by 2 give me 7.73% is what the bond price will increase by. Can you feel the common sense? No formula needed. All common sense is what you have to understand. So present price is 9431.5. 9431.5 is the present price. Right? If that price increase by 7.373%, the revised price become 10160.55. And that is what examiner is expecting you to answer. That as per Macaulay's duration estimate, although the word that he is using is wrong, It should be as per modified duration estimate. How much should the revised price be? But we know that Macaulay's never tell you the price change. It is the modified that tells you the price change, which is why we will use modified only. Could you all connect that? How do you calculate the revised price using modified duration thing? Come on, requesting your responses. So it simply involves first calculating the price. Fine, sir. Using the present value of cash flows, the DCF to be the weights, and calculating the weighted average year, which is Macaulay's. Dividing that with 1 plus time give you modified and applying the modified to the change. People, you need to answer to me. Are you settled with this particular question? Question number 31 that we have done. Come on, what do you all say? Come on, come on, come on, what do you all say? Yes? Done. Now on this category, I'll make you people solve one more question, which is the question on immunization. Right? It's not very important. It's not very important, but learning, if takes just 2 minutes, it is worth to do. If learning takes just 2 minutes, it is worth to do. Let me tell you the concept of immunization in a minute. Because Macaulay's duration and immunization are linked. What is the concept? Concept simply says, suppose I have a portfolio. Why have I kept a portfolio? Because using that portfolio, I want to meet a liability or outflow. Imagine that after 5 years, I want to go for foreign studies, which is why I have made a bond portfolio today. The simple question this concept has is, if you invest in a bond portfolio or a particular bond, which is the bond in which you would want to invest? There are multiple bonds. So I would listen to my line carefully. The question will be done. The concept will be done. I would want to invest in such a bond whose Macaulay's duration is going to be same as the Macaulay's duration of my outflow of my liability. If my liability involves making the payment after 5 years, then I should invest in such a bond whose Macaulay's duration, people in the class, is 5 years. So if you have to choose a bond, choose a bond with 5-year Macaulay's duration. But imagine that there is no 5-year bond. There is no bond having Macaulay's of 5. So there must be some bond having Macaulay's of 2 year and some bond having Macaulay's of 3 year. So sorry, 8 year for example. So now it is like you will have to create a portfolio of two bonds, 2 year and 8 year, such that the weighted average Macaulay's duration, people in the class, can become 5 year, which is the Macaulay's of my liability. So I will say I should make some investment in 2 year and similarly 1 minus W some investment in 8 year bond, such that the weighted average can become 5. So how much will these weights be is what you have to calculate. Could I, people in the class, give you a sense of what this topic involves? Finding the weights of the two bonds such that using those bonds, if I create a portfolio, then for that entire portfolio, the Macaulay's duration, which is the weighted average duration of individual bond, this Macaulay's duration should be equal to the duration of liability. Could you get it? Based on which is this particular question won't take time. You have to, I will directly narrate what the question is. There are three bonds whose maturity is given, coupon rate is given. The worst part of this question is examiner want you to calculate the Macaulay's duration for all three of them. So first, people in the class, we do calculate the Macaulay's duration. Sir, duration of bond A, duration of bond B, and duration of bond C, the same weighted average thing that we have learned. That is not the focus area. The focus area, people in the class, is now using this Macaulay's duration for immunization. Examiner says the main part that I want to teach you is here, pay attention. The bond portfolio manager has been asked to keep 45% of the portfolio money in bond A. How much of the amount to be invested in bond A out of three bonds? 45%. Calculate the amount to be invested in B and C such that the portfolio can be immunized. So we will say we want to make the investment in three bonds in such proportion that the weighted average duration of all three of them can be equal to my 6 year, the time period of liability. Do you understand? So I will say duration of first bond into the weight of first bond, 45 given. 6.86 is the duration of first bond, weight of first bond 45%. Duration of second bond is 5.84 year. If I assume the weight of second bond to be X, then duration of third bond 4.24 that you see multiplied by 1 minus X. But please, this is the point of learning here. This time I have three bond. So the sum of all three of them will be 1. So value of how much is the weight of third bond? 1 minus weight of A minus weight of B become weight of C. How many of you are able to connect to this particular part out here? This is one specific point of learning within this concept I want to tell you, where there is a possibility of silly mistake. Come on. Are you all requesting your responses connected to me on this particular point? So in this entire equation, I want that there are three bonds A, B, and C. If individual bonds Macaulay's duration is given, and if their weights are given, the weighted average I can find out. But in this situation particularly, hello sir, if weighted average I know should be 6, I have to reverse calculate how much should the weights be. If I solve this equation, I get the value of x, which is the weight of bond B, to be 36.31. So C, the weight of bond C, which is 1 minus 45% minus 36%, will be 18.69% as the weight of bond C. Is the main part which I wanted to teach you in this particular question. In the next part, they ask, listen to this. In the next part, they ask that suppose the duration changes to 7.15, 6.03, and 4.27. Is your portfolio still immunized? So we will say the amount of investment is 45%, 36%, 18%. If you have the revised Macaulay's duration, A, B, and C, and if you have their weights 45, 36, and 18, the weighted average duration becomes 6.21, and I will say it is not equal to 6, which is liabilities duration, which is why the portfolio is not immunized. People in the class, that is the main part which I wanted to teach in this particular question, question number 33, because you anyways learnt Macaulay's. So teaching immunization was just taking 5 minutes extra. Could I, people in the class, successfully do it for you? What do you all say? What do you all say? Could I successfully do it for you? So the only thing that you have to now do is the advanced capital budgeting NPV calculation, in which I have to admit something. What I have to admit? That while making the sheet, right, I made a mistake. Mistake of including one question which was a part of international capital budgeting. I by mistake put it under the category of normal capital budgeting, which is advanced capital budgeting, which involves a normal NPV calculation without forex. So logically this should be 10 and logically this should be 3. So why is there no point of covering NPV in this class? Because the questions are so diverse that solving one particular question won't give us the comfort of having the grip over the concept. Are you people understanding what I'm trying to tell you, people in the class? So we have questions of NPV calculation in the chapter of advanced capital budgeting, right? Those questions you can refer to at your own. Why we are not referring it is I have clarified. Sorted, everyone? If you are planning to figure out, sir, where do we have NPV question in the chapter of advanced capital budgeting? Let me tell you, if you go to the chapter of advanced capital budgeting, people, after this section of sensitivity analysis, scenario analysis, everything gets over. Then you have calculations of NPV. Starting with the question where you have been given notional and real revenues and cost. You have been given real revenues and real cost. You have to give the effect of inflation, convert that to notional. Then you have a question asked in November 24, right, which is a completely ambiguous question. Solving this question will not give you comfort of solving any other question, which is by not focusing on it. Then, sorry, 21 is a replacement question, not this. But September, again, there is this question that I'm showing here is asked in September 25 MTP, not September 25 exam. So this is a good question here, but is not an exam question, which is why not taking here in this batch, in this video. So that's how, people in the class, In May 25 exam, this brilliant question was asked. Again, solving this question will not give you a comfort of solving the will not give you the comfort of solving any other question. So I'm not asking you to skip it. You can go through these topics, these questions at your own, which will ultimately help you solve the questions of NPV even in the exam. Are you people understanding what's happening, guys? So except for NPV calculation, so accordingly, I cannot consider, or accordingly, let me not get into the analysis much. Accordingly, we have not considered the NPV calculation, right? Someone is asking me to remind for the decimal rule. Esther, allow me a day. Tomorrow, I'll anyways make a video on the rounding of rules and etc. things. Is that please fine? So anything that you people want to ask? So except for that particular thing, we have really done everything in both the parts of the marathon. You are done with these high priority topics, right? This is not a selection video. You have to, after this video, right, one should try to follow his plans, do other topics, right, at his own, and try to grab a bigger portion of AFM. But these were the topics which you cannot skip at all, was the point. So that was all from my side for this marathon video. You all have been really amazing when you were live, recorded people. I hope you had this good experience. The only request I have is, if your experience was really good, if you feel my efforts have made sense, please do consider sharing your feedbacks in the comment section. It really helps a new student. When a new student start to watch that video, your comments will help him get this sense of whether he should continue or he should start to watch this video or not. Getting my point? So that was all. I hope my efforts have made sense. Will meet you tomorrow with one more important video on exam tips, those 3 hour, 15 minutes, everything. So everyone, thank you so much. Let's meet back again in the next video. Bye bye. Take care. I will see you all. All the very best people. Yes. Shalini and everyone, the blessings are always there. Wishing God for your successful result, for rocking AFM paper. Okay. I really wish you make it very well. So thank you so much, Chandu, for appreciating. Everyone else, thank you so much. I'll see you all. Bye bye. Take care. All right. Bye, people. Please do consider commenting down, as I said. Like people immediately after the video gets over. Okay. I'll see you. Bye.